There's a lot of negativity hiding out in pockets of the market that have not performed.
The outlook for the equity market from here is not really that robust.
You're really seeing this pivot and rotation.
You got to follow the tech stocks. If they go down, the market's going to go down.
For most investors, they're really levered to what's happening at the Fed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. Antitrust relief for Google supporting an equity market bounce as bond market jitters keep global bond yields near multi-decade highs. Investors worldwide are looking for an extra read on the U.S. labor market in a week packed with data.
It's a week packed with data at a time where there's a perfect storm brewing in the bond market. And the key question for markets right now is just what kind of data do we need to give some calm to this storm, to give some basis for what the rate cutting cycle will be ahead of time, and how much we have to think about political dysfunction, inflation, and then maybe a U.S. economy that can keep chugging along and keeping stability on it all.
Jobs data, job openings coming up a little bit later on this morning. Let's start with this U.S. economy. ISM yesterday, not great, but the new index, new orders index, that component, that subcomponent, signaling maybe things are bouncing back, just reinforcing that sneaky bull case that's out there that we talked about yesterday, that maybe this economy could reaccelerate.
The fact that you're looking at the subcomponents of the ISM manufacturing PMIs shows you just what we're up against right now, and the fact that we're looking at any granular data to give us a hint at a time where there's less faith in the overall benchmark data that we're going to get on Friday. Look, you could pick your own adventure. This has been the story consistently throughout the year with the PMI data that we got yesterday. On one hand, it came in contraction for the sixth straight reading, not great. On the other hand, new orders, good. On the other hand, employment, bad. On the other hand, inflation seemed to be suppressed. You could pick your own story. The key question here is, going forward, is there something else brewing in bond markets that supersedes the near-term data and speaks to a question of the reaction function of central banks that allow inflation to run hotter for longer?
This is what's brewing in the commodity market right now. 7 days of gains for gold, all-time highs, 30% plus moves so far this year, and crude rolling over in the last few minutes. Brent crude down by 1.8%. This from Reuters just moments ago. OPEC Plus to consider a further oil output hike this coming weekend. This move in crude supporting the bond market, speaking to that inflationary story.
Anyone who traveled over the Labor Day weekend saw how much oil prices are really somnolent at a time of inflation elsewhere. And this has been supported by how much production there has been. And OPEC Plus, read Saudi Arabia trying to maintain its market share. Definitely a huge win in terms of suppressing inflation. How much this can really tap down longer term expectations, though, I don't know, a little bit more questionable. I was struck by this question that Morgan Stanley put out there over the weekend, that what we heard at Jackson Hole suggested a different type of reaction function where there would be an acceptance of volatile inflation into the future, which is part of what's undermining a lot of the confidence. This near-term oil price decline is really going to lead to longer-term quiet inflation.
Brent crude down by 1.8%. Brent crude this morning, 67.91. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore, with stocks looking to break a two-day slide. We'll catch up with Kate McShane of Goldman Sachs on the state of the retailers. And we'll speak to Johanna Chua of Citi as China flexes its muscles. We begin this hour with stocks bouncing back following a big win for big tech. Julian and Emanuel of Evercore looking for the S&P to rise to 7750 by the end of next year, writing investors have been offered a twice-in-a-lifetime opportunity with a technological revolution lifting stocks, multiples and society to new heights. Julian joins us now for more. Julian, good morning.
Good morning.
Bigger than the internet and pushing 8K on the S&P 500 by year-end next year. That's quite a statement.
So, look, there was a lot of consideration gone into this. And as you know, and we've talked about this a lot, two things. Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets. And so when you think about it, particularly going back to Y2K, we've seen a series of asset price inflations. I won't call them bubbles because this is not a bubble in our mind now. That one bigger than the last, obviously recoveries after a downturn, tech stocks in 2000, housing in 07, China equities actually in 2015, and then the end of the secular bond bull market in 2020. But when you look at this one, we're not even 3 years into the introduction of ChatGPT, and it is already pervading every aspect of society, every industry. And what 2025 is showing us is that companies are starting to be able to demonstrate how it actually helps business. And to us, that's a recipe for higher stock prices and the theme carrying into next year.
Well, let's go with the internet, and then let's talk about AI. There was a massive misallocation of resources that interrupted the end game. Ultimately, we got there in the end, but in the middle, what did you call it? Asset prices inflation? There was a bunch of asset price inflation.
There was a bust.
Then a bust.
Yeah.
And then we had the move to the end game. Why would this be any different?
It wouldn't necessarily be different, but again, part of it is the fact that it's too early to look at that down the cycle. We are still in the part of the sort of the discovery phase where it's very clear that there's a benefit accruing. It's very clear. I mean, think about it. You can't actually access the world's most popular search engine without engaging with AI right now. And I think demonstrably that is something that has improved information. We're starting to see, fewer problems with things that we talked about 6 months ago, hallucinations, and therefore, for us, it's really at the beginning of this entire cycle, even though, and this is part of the wall of worry that markets climb, the concerns about the CapEx overspend by necessity because the numbers are so large should be there.
There's a lot to unpack there, especially in light of what we saw overnight from the antitrust case against the world's biggest search engine. You could argue that the results of that had a lot to do with AI and that Google's fundamental business model is being challenged dramatically and could be rendered obsolete by ChatGPT. So you could say that they were let off the hook because they don't have the same kind of monopoly. I mean, how long do you think it is before people start to think about other champions of the AI revolution? And maybe these winners aren't the big winners at a time where CapEx cannot keep pace, to your point, with where we've been for the past couple of years.
Well, I think that conversation has been ongoing. You go back to DeepSeek, and that was sort of the first heart attack moment of the thought that capital could theoretically be misallocated over the long haul, which back then was the short haul. But I think there's a more important message from what we've heard in the last 16 hours or so, is that we are in an environment where regulation is going to be on the lighter touch side. And in an environment where regulation is lighter, where the Fed is likely to, if anything, ease more than perhaps the inflation data would suggest, and where you've got fiscal stimulus as well, all of that really bodes for an environment where the animal spirits, which actually, if you look at the measures, have been reasonably subdued, continue to build.
Animal spirits in the S&P 500, not animal spirits in the economy. Is this AI revolution and 20+% gains next year independent of whatever happens in the rest of the economy?
Well, it shouldn't be. And if it turns into a bubble, it likely will be. And we'll be watching that very closely. But if you look at estimates for both growth and inflation, sort of quarter by quarter over the next year or so, the trend is for inflation to moderate. Again, granted, these are forecasts, and growth to start picking up. So the direction of travel over the next year is likely to be favorable.
Speaks to the move of the last month, but the move of the last month is starting to tilt towards cyclicals. So you're talking about big tech and this mega theme of AI at a time where the Russell is starting to outperform, even at a down market in yesterday's session. Has that got legs?
We do think it does. And actually, that is one of the critical differences between now and the internet revolution, is if you looked at the last 2 years, the stock market breadth was negative, decliners over advancers, almost every day for 2 solid years. This is the diametric opposite. What we would refer this stock market in 2025 is a participatory democracy. All the boats are rising. Granted, the technology themes are outperforming dramatically, but that's what you should see in a secular theme type environment. But they're all rising.
We'll spend some time throughout this morning talking about the bond market, no doubt. Yields very close to 5% on 30-year maturities here in the United States of America. Is that beginning to become a constraint for equities?
Well, if you look at the last couple of days, it certainly is. And I think it's interesting that the thing that we feared the most back in March and April, the imposition of tariffs, is theoretically the thing that's caused the bond market ruckus of the last few days, that the tariffs might be removed. So it's sort of, on the one hand, on the other hand, we don't like two-handed economists. Two-handed strategists are okay. From our point of view, ultimately, look at the 10-year yield, right? 4.27. And you could say that the 30-year yield is the benchmark, but really the 10-year yield is, and certainly that's where Secretary Bessent has the focus, smack in the middle of the range. Our work has shown once you climb above 4 3/4, it's a headwind for stocks. Above 5 is something else entirely, but we're a long way from that.
And just to touch on what you just said then, just a few moments earlier, this is a bond market dependent on the tariff revenue. Do you believe that now?
I think the jury's still out. I really do. But I do think that when you talk to our policy people, that the Trump administration will find a way to have the tariff revenue continue, even if the courts end up ruling against. There are other avenues to pursue.
Julian, you're going to stick with us. Julian Emanuel of Evercore. Your bond market is settling down just a little bit. 30s here, Lisa. Yields up only by a single basis point now. Likewise on 10s and on 2s.
Although globally at the highest levels in multi-decades. So we are definitely at pretty high levels. And there's a question of whether this is high enough to prompt some sort of response from governments around the world. And that is what we're trying to hear from a couple of different politicians. We'll do whatever it takes, even take away 2 holidays. But is it enough? And that's really the question.
Did you draw any conclusions on the price action of yesterday, worldwide, the global moves?
As to why this was happening, this was actually the key question for me coming into today. Why is the bond market selling off now? We've known all of these things, but some sort of toxic brew of political dysfunction, the idea of inflation readings come in just a little bit hotter, and the change in reaction function at the Fed, to me, come together in something that's just not kind of settling well. People need a Pepsid. I
understand what was happening yesterday, but I was frustrated by how many people threw all these different moves into the same bucket, as if it was one kind of a single theme driving everything. And if you break it down, let's go from the end of July and take the yield curve stateside and compare it to the yield curve in, say, France, and overlay the move with where we've been and what we've done over the last month or so, you'll see a massive bull steepener in America. Post-payrolls, Chairman Powell endorsing the move, basically, 2-year yield drops aggressively. 10s and 30s have actually been pretty stable over the last month. If you have a look at what the yield curve's done in France, you'll see a massive bear steepener. Front end's been pretty anchored, hardly moved. Kind of the complete opposite story that was played out here, and all the flexibility has been at the long end of the curve. So what you see in France is a bear steepener. Bull steepener in the States, bear steepener in France. And what I see, just a basic judgment there, is a market being driven by the Fed in the States and being driven by fiscal concerns in France. That's not the same thing, which is why we said yesterday, I think we're on the right line of things here. This is why I think if you're at the Treasury at the moment, you're a little bit more comfortable with the moves you're seeing than you would be if you were over in France. They're 2 very different stories for me at the moment.
And it's the reason why Scott Bessent was saying Japan needs to get its house in order, not necessarily that the Fed needs to do yield curve control. So there clearly is a recognition of how global the story is.
Just a bit of stability, both in France and the US, at least so far this morning. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Johanna for more. Hey, Johanna.
Hi, John. We start with that big win for Alphabet. Shares are rising nearly 6% after a judge ruled the search giant won't be forced to sell its Chrome business in a landmark antitrust case. Google will, however, be required to share online search data with its rivals. The search giant will no longer be able to make contracts exclusive, but can still pay other companies to feature or default Google products. Meanwhile, the U.S. Treasury Secretary Scott Bessent will start interviewing candidates to replace Fed Chair Jay Powell this Friday. The Wall Street Journal is reporting that Bessent will talk to candidates either in person or by video conference. There are 11 contenders for the job, and Bessent plans to recommend a finalist to President Trump. And Petrobras CEO Magda Chambriard says the company is in a favorable position to withstand the U.S. trade war. She spoke to our own Annmarie Hordern in Sao Paulo.
We export very little to the United States. So even if we were reached by the 50%, our export would be easily directed. We have India, China, Asia, they all demand a lot of our products. So we wouldn't be very difficult to remanage.
The biggest market for the Brazilian energy company. That's your Bloomberg Brief. John?
Johanna, thank you. More from Johanna in about 30 minutes' time. More from Annmarie potentially tomorrow, if she makes it back from Brazil. Gets some terrible gigs, Annmarie does, doesn't she?
She has got really good frequent flyer miles, and she probably has that sort of like club key where she can go and check in with the various CEOs of airlines. We'll find out.
We'll see if she makes it back from Sao Paulo in time for the show tomorrow. Up next on the programme, a legal victory for Google.
The reason people use Google is because they want to use it. Choice is good for users, competition is good for the world. Some of the proposed solutions are far overreaching. We'll see how it plays out.
It played out quite nicely. Bloomberg's Tyler Kendall joins us next. That stock is up by 6%. Thank you, Google. Thank you, Apple. Thanks to a judge down in Washington, D.C. Equity futures bouncing back, positive by 0.4% on the S&P. On the Nasdaq, up by 0.6%. In the bond market, looking for some stability here, a firmer footing for bond markets worldwide. Yields higher by just 2 basis points on 10s, 428.28 on 30s, 497.69 within 1 basis point. Earlier in the session of 5% on 30-year bond yields. Helped out by this move in the commodity market. Crude lower today, rolling over in the last 30 minutes or so. We're down by about 1.8% on Brent crude. The latest from Reuters, Bramo, that maybe OPEC is considering a supply boost over the weekend.
Yeah, and why? I think that's the real question. Why would they boost supply unless they're just continuing to try to gain market share at a time when Saudi Arabia is saying, now is our moment, pump, baby, pump. We're also seeing Norway saying, pump, baby, pump. Everyone is saying that, which raises a question of the U.S. shale patch and just who are they gaining share from? And that is going to be something a lot of people are looking at.
Brent crude, 67.92. Out of surveillance this morning, let's talk about tech. A legal victory for Google.
The reason people use Google is because they want to use it. Choice is good for users, competition is good for the world. Some of the proposed solutions are far overreaching. We'll see how it plays out.
Well, here's the latest this morning. Alphabet shares rising in the pre-market by more than 6% after a federal judge ruled Google does not have to sell its Chrome browser. With the latest, here's Bloomberg's Tyler Kendall with more. Morning, Tyler.
Hey, John. Good morning. This is considered to be one of the biggest U.S. antitrust cases in nearly 30 years. And as you mentioned, Google was able to avoid some of the harshest penalties that were on the table, including the forced sale of its Chrome business. But it will be required to share its search engine data with competitors. That means that data is going to be used to build out other search engines, including from rivals like Microsoft and DuckDuckGo. But it will also be used to build out AI, artificial intelligence models, giving a boost to companies like Perplexity and OpenAI. Now, this is considered to be a blow for the government and the Trump administration, which was seeking those harsher consequences, considering that the court had actually sided with the government last year when it ruled that Google had monopolized the market for search engine and search advertising. We did hear from the top antitrust enforcer at the DOJ, Abigail Slater, who said in a post that the government is weighing its options going forward here. It was actually interesting. If you looked at the ruling itself, the judge had suggested that the government overstepped its legal authority by trying to force the divestiture of key assets like Chrome. Now, the administration did extract some other concessions, including barring the company from entering into any exclusive contracts to be the only search engine on devices and platforms, though they are allowed to still pay for that placement. John, this caps off an about 5-year legal battle that started under the first Trump administration, though it isn't quite over. Both sides have until September 10th to file some additional filings and submit an updated remedy plan. But this is being looked at very closely as a potential blueprint for other judges judges as they consider other big tech cases around the country.
Tyler, before you go, Julian Emanuel is sitting on set with us, and he said the fact that this was upended highlights the light regulatory touch of this administration. Do we have a sense of whether the administration is going to back away from any of its efforts to try to deploy antitrust tools when it comes to big tech in particular?
Well, it's actually been a really interesting needle that the administration has been threading here, Lisa, because actually antitrust enforcement was one of those areas that we heard the Trump administration come in and say that they were going to uphold, actually keeping on some of those cases that started under the FTC's Lina Khan in the Biden administration as one example. We know that this is an area that especially Vice President J.D. Vance actually campaigned heavily on, perhaps those more populist messaging that we saw on the campaign trail when it came to taking on big tech. So it's something that we're watching closely here. But at this point, it's not totally clear if the White House is going to back off, considering that we did hear from top DOJ officials yesterday saying that they are still going to look at their options going forward.
Tyler Kendall down in D.C. More from Tyler in the next hour. Tyler, thank you. You kind of touched on this, Bramo, at the start of the show. The biggest threat to Google right now is not the regulator. It's the competition. Let's get it straight here. That's the biggest threat to Google at the moment.
To me, I wonder, is this a bigger win for Google or a bigger win for Apple, which keeps its $20 billion of revenue for just a touch longer while it tries to revive itself? I mean, to me, Google is facing an existential threat far greater than the Department of Justice.
So Julian's still with us. Julian, let's breathe some life into this conversation. Will the winners this time come from the same places? Or to Lisa's point, do you need to look elsewhere?
Well, again, to your point, is that, it wasn't just Google that won in the aftermarket yesterday. Clearly, it was Apple. And there have been questions about, who's ahead, who's behind in the competitive landscape within the Mag 7 itself. But I think it goes back to the point that when you think about it from the long term, this is still more a business of scale and capital formation. And, we have seen an environment where the big and the winners keep winning, and simply because these companies are producing revenues and earnings and cash flow to fund more of the investment. So that cycle to us, is part of our view of the landscape into next year.
As part of your bull case, you talk about a light regulatory touch, and yet it seems like this is going against the wishes of the administration, and their touch isn't so light when it comes to big tech, or at least they don't want it to be so light. And this isn't the end of it. So how do you sort of square those things? The idea that it's really good for the rest of the 493, but not so much for these?
Well, again, I think, as Tyler pointed out, there's a lot of mixed messages going on. And clearly, when you think about the announcements about the interlocking between government and business that we've heard at various times over these first 6 or 7 months, it's an open question as to how it evolves. But I think in the final analysis, the way you look at the Trump administration is they're pro-growth, they're pro-business, and certainly the equity market is a very large part of that.
You see it as a complementary relationship and not a disruptive one?
I think there's plenty of disruption. There's lots of questions about government intervention in business, government directing of business. But our job right now is to interpret how the stock market is interpreting that. And at the moment, it's a rather profound positive.
You are super bullish going into next year. It's good to catch up with you. Appreciate it. Thank you, Julian. Julian Emanuel there of Evercore ISI. And if you have been bullish through most of this year, you've been right. That's for sure, based on a bounce back we saw from the April lows.
Bullish on stocks, bullish on the economy, bigger question. And when you take a look at the earnings, the actual increase that you've seen in sales has come from inflation, has come from jacking up prices, and it's come from job cuts or cutting some of the expenses. So you look at that and you wonder, can you have a market that continues to run another 20+% with an economy that just never catches up?
Some tension building there. Big time. Totally agree. Up next on the programme, Kate McShane of Goldman Sachs on how retailers are navigating the uncertainty. Plus, we'll touch base with Danny with your morning movers as Apple gets a boost from Google's court victory. That's all still to come, live from New York City. You're watching Bloomberg TV. Taking some heat out of the summer rally in yesterday's session to kick off the month of September. This morning, bouncing back by 0.5% on the S&P. On the Nasdaq, up by 0.7%. Big tilt to Google, to Apple. Danny will get that in just a moment. I want to turn to the bond market. 2-year, 10-year and 30-year. Looking for some stability here. Yields up again by 2 basis points, 4.2828. 5%'s turned out to be a bit of a ceiling for the 30-year bond yield. Bumped up against it a few times. Once yesterday, again earlier this morning, within 1%, 1 basis point rather, of 5% earlier on in the session, 497.69. But the story that keeps on running is gold. 7 days of gains potentially for gold, the longest winning run on a daily basis for the year so far, a move of more than 30% for 2025.
Where do you find a haven right now if you're worried about political dysfunction and inflation in the likes of Japan that has superseded what we are seeing in the United States for the first time in some 40 years? This is a time when people are increasingly turning to gold, and they are following all of the central bank's reserves, which have been inflating with gold in a significant way to the detriment of global bonds around the world. So to me, this is actually the story to watch. How much is this the arbiter of going forward? How much people have distaste for developed market sovereign debt?
What a move we've seen, Lisa. 35, 37 so far this morning. That's the precious metal story. Let's get you an equity update with some single names, your morning movers with Danny Berger. Hey, Danny.
Hey, John, let me show you those tech stocks because it is what's supporting this equity market this morning. Google shares up more than 6% after a judge ruled that they would not have to get rid and sell off their Chrome browser as a part of that monopoly case. It avoids the harshest penalty for Alphabet. And yes, they can't have exclusive contracts. They have to share their data, but still all a net positive. Also a net positive for Apple because as part of this ruling, they can continue to give payments to Apple to make Chrome their default browser. Apple's already given users other options besides Chrome if they want to change their default browser. So already taken remedies there. The judge did say, though, that could be revisited. Even so, we buy now, ask later. 3.4% is the rally we're seeing pre-market. Finally, following up on some news yesterday when we learned that Kraft Heinz would be splitting into 2 different companies. It had a really rough go of it yesterday. For one, Warren Buffett came out against it. Shares fell some 6%. This morning, Morgan Stanley gives an upgrade to Kraft Heinz, saying that the split is a good idea and it puts a floor on how much the stock can fall, and it helps support valuation. So those shares up 1.4%, John.
Danny with the latest. Danny, appreciate it. More from Danny in the next hour. On a radar this morning, China showcasing its influence with a large-scale military parade in Beijing attended by Russia's leader Vladimir Putin and North Korea's Kim Jong-un. President Trump then posting a message accusing the leaders of conspiring against the United States.
Well, the goal was to send the United States a huge message here, which was we have weapons that we have not used yet, hypersonic, supersonic, extraordinary sonic, that we can launch from submarines and from ships that could potentially expedite A, our takeover of Taiwan, and B, a pushback from whatever you may do. And this comes at a time where we are seeing the first ever meeting of Xi Jinping, Vladimir Putin, and Kim Jong-un. It's sort of this axis of others that is over there. And it's really a question of, what the message and what the response will be from the Western world.
One thing that dictators do really well, parades like this, pretty phenomenal. Everything's on point. If you have a good parade in a democracy, I get concerned, because I want everyone focused on other things.
Well, congratulations, because we had a terrible parade here in the United States. Not a terrible parade, but it wasn't like that. People were humans. They weren't sort of all to a T in terms of how they march and how many tanks and how many other missiles and how orchestrated it could be, and people all saying things in unison. We didn't have that in Washington, D.C., and maybe that was what some people would like. But here's the question. Is this more for an optical type of show, or is this actual? Is this the type of weaponry that could really put China on an equal footing with the United States from a military perspective and demonstrate their prowess on an international stage as Xi Jinping tries to be the international statesman?
Yeah.
Or is this a show trying to force the United States' hand?
A more serious tone? I think it used to be very much the former. There's a greater concern now, it's the latter, and that's problematic. And I think we have to take that more and more seriously in the months and years to come.
And this is the reason why people are focused on AI and how much the race between the U.S. and China, because those weapons look lovely. But the real issue is the AI fight is very much intertwined with the military fight and the new frontiers for warfare.
That's the latest on China. We'll bring you an update there a little bit later this morning. I want to turn to the latest down in Washington, D.C. The Treasury Secretary, Scott Bessent, will begin interviewing candidates to replace Fed Chair Jay Powell on Friday. The Wall Street Journal reporting that 11 contenders remain in the mix. The Treasury Secretary is going to sit down with a handful of them and then ultimately shorten down this list and hand it off to the president.
To me, I was surprised it hadn't started already. My takeaway wasn't, oh my goodness, it's so early, because the replacement has to come at some point early next year. This is almost on a schedule that would make sense. The bigger thing to me was, A, it's not taking place just of yet. He still has 11 candidates. His name is not among them. And the idea that we're still talking about the same story indicates that maybe they haven't been moving quite as quickly as some people had expected.
I agree with you. I agree with you on that. I think we're still on Besson's timeline.
Totally.
And not on the president's. This could still take a while. I'd also say that the Treasury Secretary, I imagine, wants to bring a lot of credibility to this process so that the markets really believe in whoever is ultimately selected to be the next Fed chair. I think it takes some pressure off the Treasury Secretary and the Fed chair going into September 17th. That will be the last meeting, I think, for Chairman Powell to provide some forecasts without the disruption of knowing who the next Fed chair is. After that, it's game on. I'm going to be looking for guidance into 26, not from the Fed chair, but whoever the person is that the president selects.
And what the criteria are. Are they looking for someone who will err on the side of hotter inflation in terms of hotter growth? Or are they going to err on the side of credibility in markets and tamping down the 30-year, the 10-year yields? That's going to be crucial at a time where Scott Besson has said the Fed should be an independent body, but they've also made a lot of mistakes. He keeps repeating that in the way he messages this.
The process is well underway. I want to turn to this story from Alphabet. The big news in the equity market this morning. Shares surging after notching a major win at the biggest US antitrust trial in almost 3 decades. A judge ruling Google would be required to share online search data with its rivals, but won't have to sell its web browser. That stock is up this morning by more than 6%. Let's turn to the consumer. Kate McShane, a US retail analyst at Goldman Sachs, writing this. We have seen growing concerns around the health of the US consumer. However, we expect a combination of job growth, easing interest rates, and more benign essential spending to translate into resilient spending power. Kate joins us now for more. Kate, welcome to the program. Let's just build on your outlook. We've seen a market start to believe in a pickup in this economy. Are you hearing the same thing from the companies you follow?
I think we are. I think there is some hesitation going into the back half of the year in terms of what some of the higher prices we could see as a result of tariffs could mean for the consumer. But as we enter into 2026, and we published on this yesterday, we do expect to see an accelerating cash flow for the consumer, especially with that middle income consumer.
How much, Kate, has the expansion or the rosier outlooks from the retailers come from the idea of more robust demand from consumers? And how much has come from the fact that they can raise prices and cut staff or cut costs around the corners and maybe deploy a little AI, deploy a little something else?
I do think there is a strong underlying demand that's underpinning the sales that we're hearing and seeing from retailers. What we've heard for the last couple of years is that while the consumer is being choiceful, they do respond to newness and to innovation. And we've heard so far that back to school has been very strong as well. And back to school is usually a very good future indicator for how holiday will turn out. And so I do think that there is a fairly healthy consumer that is underpinning the demand for these discretionary sales.
How much, Kate, is this affected by some of the uncertainty that we've seen? There was this expectation that heading into the end of the year, there would be more certainty around policy, more certainty about, what was coming down the pike. And now we have the question about the legality of some of the tariffs. We have questions around what is going to happen with the budget deficit, a government shutdown. I mean, is that basically not on the minds of a lot of the executives that you're talking to there?
Oh, I think the uncertainty is definitely something all of our companies that we cover have spoken to. I think there is a lot of uncertainty in terms of how things will play out, again, in the back half of the year. I don't think we've seen as much fear from the consumer, though. We haven't heard as much of pull forward in anticipation of potentially higher prices in the back half of the year. Everything seems somewhat normal when it comes to the consumer pattern of spending.
Kate, I want to just ask, we've been talking all morning about the proliferation of artificial intelligence and how a number of different companies are using it and how it is migrating from the Magnificent Seven to the rest of the names in the index and beyond. Are you hearing about tangible ways that retailers are using the latest technology to either facilitate sales, reduce costs, or even just improve processes?
Yes, I would say within the last couple of quarters, we have definitely seen the narrative around AI accelerate in terms of how these companies are thinking about the future. We do hear it in the context of efficiency, I think a little bit more than anything else. Think supply chain, think e-commerce and product descriptions. There's a lot of things that they're talking about kind of early on here, but I think we're going to hear a lot more in the next couple of quarters of, again, how it's improving efficiency at all these companies.
Kate, we know we've got a busy morning ahead of you, so thanks for making some time for us. Kate McShane there of Goldman Sachs at a busy Goldman Sachs annual retailing conference as they get set up for that throughout today.
Yeah, how do they give guidance? I mean, honestly, how do they understand how to even measure tariffs that may be taken on, may be put off? I mean, the idea that the court delayed any kind of implementation of the decision until October 14th raises a real question. After October 14th, do companies, suppliers go to the government and say, where's our money back? How do we just continue with our lives? How much are we looking at them actually expanding overseas programs? There are tactical questions that a lot of these guys probably don't have answers to.
This is not an event, it's a process. I keep going back to that. This is not an event, it's a process. It takes time. It takes a long, long time to play out. So what do we know so far? Basically, what we know so far from import prices is that we haven't seen the people shipping this stuff into America drop their prices aggressively. That's not happened. What we've seen in end consumer prices is we haven't seen this passed on aggressively. That's not happened yet. Maybe it does, maybe it won't, I don't know. What we've seen so far is companies have taken a lot of this on margin, just based on the economic data, very surface level analysis. What I don't know is what happens next, because at this point you'd have to imagine these retailers are now negotiating with their foreign suppliers to try and work something out. If they can't, they then need to gauge the strength of the US economy, whether they can actually pass on price hikes or not. And if they can't, they've then got to figure out, OK, what do we do? Go over market share? Go after it? Walmart? Maybe. If you're in that position, you have that strength. Or do we have to cut costs? And if we have to cut costs and we start seeing this show up in labour, then you've got to be much, much more concerned about what happens next in this economy.
I paid $4 for a box of pencils. And this is really the issue. I was going through the list thinking, what do I need to buy for the back-to-school supplies and the household need? And it was a pretty big tally. And I'm not going to not buy pencils, right? So at what point is this sort of the staples that people have to buy versus some indication of strength going forward? That's also what I'm looking to parse through. How much are these necessities, essentially? You need your binders. You need to collect your homework. You need to actually write it down. You know, you need to actually do it. Okay, I'm digressing.
This doesn't sound like this is about the programme. It's about something else. But I'm totally there with you. Look, this is going to take time to play out. What frustrates me at the moment is how political the analysis has become. You're either for the president, against the president. For me, just stay open-minded about the situation. We haven't seen this ever before in modern history, the kind of move the president has made, in post-war history at least, to aggressively hike tariffs in the way that he has. I don't know how this plays out. I can just observe how it's playing out in real time and just acknowledge that I've got to be open-minded about what the future holds here, because no one really knows.
Mohamed El-Erian made a point that really stands out in my mind, and it was a while ago where he said, remember when you used to go to the store and you would get a product and it would say, suggested retail price, 99 cents, suggested retail price, $1.99. You don't see that anymore. The whole idea of stable prices has gone away, which leaves open the possibility of volatility and inflation and real-time price increases that is very different than what we've seen in the past.
In the stock market this morning, if you are just joining us, welcome to the programme. Equity futures are bouncing back by 0.5%. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's check in with Johanna for more. Hey, Johanna.
Hi, John. Fed Governor Lisa Cook's lawyer blasted President Trump's move to oust her, saying his accusations are based on nothing more than cut-and-paste allegations of mortgage fraud made on social media. He doubled down on arguments he presented last week, saying Trump lacked valid grounds to fire Cook for cause, a key issue in the suit challenging her dismissal. Meanwhile, Jane Street pulled in a record more than $10 billion in net trading revenue in the second quarter, beating out all of Wall Street's biggest banks, with trading revenue from JPMorgan trailing behind by just over $1 billion. Sources telling us here at Bloomberg, Jane Street logged a record $17.3 billion in trading revenue during the first half of this year. And Hawaii's Kilauea volcano resumed erupting yesterday, shooting lava 330 feet into the sky. All of the lava has been contained and hasn't threatened homes or buildings. Kilauea is one of the world's most active volcanoes. This is the 32nd time it has erupted since December. That's your Bloomberg Brief. John.
Hey, Johanna, thank you. More from Johanna in the next hour in about 30 minutes from now. Up next on the programme, undoing diplomacy.
A lot of countries are backing away from their close relationships with the United States. We're going to wake up 5 years from now. We're going to realize that we've just undid 20 years of diplomacy that have sort of pushed back against a China-led world. It's a problem.
We'll get to that problem next on the programme. We'll catch up with Johanna Chua of Citi from New York. This is Bloomberg. Equities bouncing back by 0.5% on the S&P 500, driven by gains for Google, for Apple. The Nasdaq 100 up by 0.7. That's the price action in the equity market under surveillance this morning, undoing diplomacy.
A lot of countries are backing away from their close relationships with the United States. We're seeing a situation where China is becoming an attractive option because it's not the United States right now. We're going to wake up 5 years from now. We're going to realize that we've just undid 20 years of diplomacy that have sort of pushed back against a China-led world. It's a problem.
So here's the latest this morning. Chinese President Xi Jinping hosting Russia's Vladimir Putin and North Korea's Kim Jong-un in Beijing for a once-a-decade military parade. Joining us now to discuss is Bloomberg's Min Lo. Min, welcome back to the programme. I'll tell you the message that's coming from America so far this morning. This from the President to Xi. Please give my warmest regards to Putin and Kim Jong-un as you conspire against the United States of America. What's the response from Asia this morning?
Well, President Xi didn't mention America at all in his speech. And I mean, you think about it, President Xi's speech is probably drafted a long time ago. He's unlikely to change it to respond to a tweet from President Trump. But Trump was asking whether China will mention the U.S. at all and its role in aiding China during World War II. And President Xi, in his speech, of course, he thanked the Chinese veterans for their sacrifices, but he also made a nod to foreign countries. Didn't name drop the U.S., though. He mentioned foreign countries' help in helping China secure its freedom and its freedom from World War II. And of course, what's unsaid is the imagery you get out of this, right? Because Kim Jong-un and Putin flanking President Xi, some analysts have called these an axis of upheaval. And it's not just these two countries. You have the leader of Iran, the leader of Myanmar as well, some of the most sanctioned countries present at this gathering of at least 26 leaders who are there. And interesting as well, you look at the guest list. Obviously, US and UK are not present. There are only two European leaders, Serbia and Slovak is there. But then there is all of these Asian leaders as well, many of the Southeast Asian leaders, including Vietnam, Malaysia. President Prabowo, he was supposed to attend the SEO summit over the weekend. He didn't go because of the protests happening in Indonesia, and he caught a last-minute flight to make it for the parade. And it shows you that, yes, China has this influence, especially over the ASEAN countries who continue to rely heavily on China on trade, and they're perhaps a little bit agnostic to the ideological overtones here and the image of that, you know, the strongman leaders standing together on stage on that days above the portrait of Mao Zedong at the Tiananmen Square.
Min, great reporting in the last 24 hours. Appreciate the coverage. Min Lo there of Bloomberg out of Beijing. To extend the conversation, Johanna Chua, the chief Asia economist and head of emerging market economics at Citi, joins us now for more. Johanna, good morning.
Hi, good morning.
Thanks for being here again. It's been about a year, I think,
yes.
So welcome back.
Yes, happy
Let's
to be
talk
here.
about China. We can avoid the politics if we can. We want to know what's happening with that economy. The Treasury Secretary has sat in your seat, that very chair, and talked about China rebalancing, needing China to rebalance. Are you seeing any rebalancing at all?
Well, so far, no. In fact, if you look at the first half GDP growth in China, net exports contributed an even higher share of GDP growth, about 32% versus last year, 30%. But hey, contributing 30% or more than 30% of your growth for the last year and a half for the second largest economy, that's very challenging for the rest of the world. Now, the hope is we've got the 15th five-year plan coming up in October. Maybe there'll be some kind of rumblings about rebalancing, but at the moment, it's still very early days. There seems to be some signs of shift towards supply side reform, anti-involution, trying to cut excess capacity. But, domestic demand still has a lot of challenges.
So just to put a sort of a bow on this, are you seeing anything in any of the Chinese policies that would fight deflation?
Well, there's been obviously a lot of news coming up, with these kind of lithium mining kind of being shut down. Obviously there's been some, it looks like there's some talk about capacity cuts, instructions from companies not to kind of, have a kind of continued price war. So there seems to be symbolically early signs. But again, we have to see first in the data. It's still very early days. I mean, I think the last CPI data came out. There was a little bit of some signs of a bounce in certain items. But again, overall, inflation is still extremely low.
When we look at the optics of this new alliance, or not new, but sort of reiterating the alliance between Vladimir Putin, Kim Jong-un, and Xi Jinping, and then all of the people in attendance, do you see that in some of the export numbers? The exports really are coming from China and going much more so to all of these countries that are now emboldened friends.
Well, Russia, North Korea is not really the major trading partner. I think the very strong signs we've seen in the last couple of years is really this dramatic increase in China's exports to the global south. And it's been happening over the last couple of years. It's increased a lot to Latin America. It's increased a lot even to Africa and also parts of Asia like ASEAN. Unfortunately, what that's happened is it's not just exports that have diverted to those countries, but China's trade surplus has mostly come from the global south. So there is a question about how long can you keep this going? What is the absorption capacity of the global south to be running very large trade deficits? Like, for example, I think the image of this Shanghai Cooperation Summit and Modi there, if you look at India and China's economic relationship, India runs a large trade deficit with China. And then it runs a trade surplus with the U.S. Now, how do we rebalance that relationship economically when strategic kind of geopolitical relationships are always changing is obviously something that's going to be a challenge.
Are any countries pushing back? And not just the countries that you've labelled already, you've named. I wonder if Europe is starting to push back as well. We've had this conversation now for a number of months that this overcapacity has to be eaten by someone. Either it's the Chinese or it's the people they export to.
No, look, Europe has already been pushing back. We've had already this news of this kind of tariff on EVs, and, we've seen that news. Obviously, U.S. is pushing back the most aggressively. EU is doing it in a more targeted rather than a blanket way because obviously they have a more kind of rules-based mechanism. You do see a lot of kind of even smaller countries kind of filing WTO complaints, but we have to acknowledge the fact that since China is the largest trading partner for most countries, there's a little bit of asymmetric leverage here when it comes to bargaining position. So it's always going to be a bit of a challenge. And though countries will lodge complaints or do it on a more targeted basis, I think overall there's a limit to what they can do. That's why these trade surpluses that China is running with these countries continue to grow.
As you know, the US has pushed back aggressively against transshipping, trying to get these countries to put their tariffs up. Now, are you seeing any signs of that rebalance at all so far?
No. So actually what's happening now, it's ironic because at the start of the year, everyone thought, Trump was campaigning 60% tariff on China, 10% on everyone else.
Yep.
So we thought, there's going to be a very wide wedge and it will drive production relocation to other countries. Now it's coming out that the tariff differential is not really as wide as people earlier thought. In fact, ironically, India now gets a higher tariff effectively than China. And then this whole transshipment thing, I think there's been some kind of talk about pressure on Mexico. Obviously, Mexico has a lot more closer relationship with the U.S., so there's some talk that they might put a tariff wall on China in their upcoming budget. But for ASEAN, it's very, very complicated. Now, what we're hearing is that it looks like U.S. is pushing ASEAN, particularly there was some news about Thai officials being told that they have to raise their domestic value-added content in their exports to at least 60% in order to avail of their 19% tariff kind of rate. Otherwise, they could get slapped transshipment. And that's going to be a challenge because a lot of countries have very integrated supply chain and some of that foreign content obviously comes from China.
Can we do this more than once a year? Let's do it try for twice a year. Let's make it happen.
Absolutely.
It's good to see you here in New York. Thanks for being here. Johanna Chua there of Citi. The second hour of Bloomberg Surveillance is just around the corner. In just a moment, we'll catch up with John Bilton of JPMorgan.
The bond market is telling you, not just here, but everywhere else, that it's worried about the path that we're on.
We have seen fiscal concerns pretty much across the board.
If inflation's going higher, that means the yields are going higher.
Things will calm down over the course of the next couple of months.
That's really what's important for the U.S. economy is getting those long-term interest rates to begin to trend lower.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's a much calmer second day to September trading. Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now with equities bouncing back by 0.5% on the S&P, by 0.8% on the Nasdaq 100. Some antitrust relief for Google, helping out that stock and helping out Apple too. That's the story for equities. In the bond market, things just settled down a touch. 30-year bond yield short of 5%, 497.48, up a single basis point. 10's up to 428.28 rather. That's the bond market situation. As for the week ahead, some economic data for you. Job openings, jolts a little bit later on this morning. Look out for that. Then we get ADP and claims tomorrow. Then it's on to Friday. It's the payrolls report. Just what is the state of the US economy? So let's talk about that. Let's talk about one single name. Macy's raising its outlook. For the US consumer, just how dicey are things right now? Because this stock is up 4.9%.
And we just heard from Kate McShane that the outlooks over at the Goldman Sachs Retailing Conference are much more positive than they were just a couple of months ago. The question is, from where? How much is this just raising the bar a touch after it was lowered dramatically because of the tariffs on April 2nd? When you take a look at what Macy's is talking about, yes, they upgraded their forecasts and they beat expectations, but it still is below where they came out with projections before that April 2nd announcement. So a real question here, have we reset our expectations? Where is the strength coming from? And how much is Macy's just charging a lot of money for the Blue Mercury products and getting a real boost from it?
I think it's a little bit of everything, especially the latter. That stock is now up by close to 9%. I'm allowed to mention a subcomponent of the ISM?
You are allowed. Fine. Go ahead.
Okay. New orders bouncing back. Forward-looking indicator. If you wanted to sprinkle a good news in the last 24 hours, maybe a sign that perhaps this economy is gearing up to bounce back. Do we see that in payrolls on Friday? Absolutely no idea. But that's the story in this equity market of the past month.
If you want to take that component and create a story, there's an issue of confidence and this reinvestment that a lot of people were talking about as a sneaky bull case, as Stuart Kaiser put it, or there's this idea that maybe a lot of companies which pressed the pause button in the wake of the tariffs to try to work through their inventory are now empty and have to reorder and re-up. And how much is that part of the story, which also will give a boost to the economy? Either way, this is a very complicated moment. And you might see everyone trying to struggle with it as they try to explain why is the bond market selling off? How much does this market have legs? It is because it's at a tipping point for a host of different themes, whether it's the AI theme, whether it's the economy theme, or whether it's a political dysfunction around the world.
Bond market selling off this morning just a little bit. Yields higher by a couple of basis points across the curve. Coming up this hour, we'll catch up with John Bilton of JPMorgan as the global bond sell-off hits stocks. Libby Cantrell of PIMCO as Fed Chair. Jay Powell interviews, or rather the Fed Chair interviews begin. And Bloomberg's Jamie Rush as European bond yields hit multi-year highs. We begin this hour with stocks bouncing back and bonds finding a firmer footing. John Bilton of JPMorgan writing, we see US Treasuries in a range of 450 to 375 and favour a modest overweight to duration. The steepening bias in the US probably persists given concerns over Fed independence. John joins us now for more. John, good morning. Good to see you. The bond market moves have settled down, at least so far this morning, but they were vicious at times in yesterday's session, particularly in places like France and the UK. Anything to be concerned about?
Well, I think there's a couple of things going on here. I mean, first and foremost, remember which month we're in. This is September. It's back to school for the kids. It's back to new issuance for the bond markets. And it's always a big issuance month. I mean, we saw a 50 billion euro set of issuance coming out of Europe, but we had a UK bond issuance in the 10-year note that was actually reasonably well subscribed. We had 40% international involvement there. So this is not a bond market which is not functioning. It's a bond market that's repricing. And what it's repricing to are some of the fiscal risks. We know about some of the political turmoil in France. We know about some of the fiscal concerns in the UK. And this is all contributing to this general feeling of concern and within bond markets generally. Of course, here in the US, question marks around sort of fiscal impact of inflation also having an effect there. And that's pushing the back end of curves up to new highs.
Do you think it's back to school for fiscal authorities? Is this enough to force corrective action in places like the UK, like France?
Well, I think, we now know that we're going to get a budget on the 26th of November in the UK. We know that there are issues in terms of, balancing spending and investment in the UK. So I think there's a number of things going on here. I think first and foremost, we're repricing to realise that the UK does have this persistent inflationary problem because of supply-side constraints, which is a battle for the Bank of England. And secondly, it's a question of how does the UK invest for growth? without upsetting the bond market. So I think that there is this fiscal repricing going on. What gives me encouragement, though, despite us being at the highest level of 30-year bond yields in the UK since 1998, what does give me comfort is the market continues to function. I'd also throw something else in there, which is the technicals here. Remember, in Europe, we've seen big changes to things like the Dutch pension demand for European bonds. We're seeing repricing continuing to come through from liability-driven investors in terms of how they structure their investment platforms. So not all of this is about fiscal. Some of it is about market mechanics.
If the best thing you can say about a bond market is it didn't break, then you wonder how positive a person can actually be. I mean, are you actually bullish on long-term bonds? Are you just trying to say, look, it's not exactly, hands up in the air, flames behind us, the world is burning down, Liz Truss type of moment, even though yields are high. Yeah. Which is it? Bullish or just let's ratchet back some of the more crisis speak?
I think it's more the latter. And I mean, look at the quote that John put on the screen for me where we're talking about the continued steepening bias. We continue to expect to see that because we do have inflation uncertainty. In our work this year in our long-term capital market assumptions programme, we've looked at the average level of inflation and we expect it to be kind of close to central bank targets, maybe a touch above. But what we do think is more inflation volatility. Forces like technology, the energy market pulling it down, forces like fiscal overreach in places pushing it up. And so we'll swing back and forth between points where we see a little bit more inflation coming through. Investors are going to demand more term risk premium as a result. If we look at that in return terms, sure, we've got more volatility, but markets are repricing to reflect that. So it's not necessarily a bullish call on bonds, to be clear here, but it's an expectation that we're seeing a functioning market reprice to set the appropriate level of return given the fiscal risks that are out there.
Does it make sense to hear people bullish on risk assets in this type of setting at a time where you could get governments being forced to cut back spending in order to tame some of the long bond jitters that we have seen recently, and there's a sort of valuation concern with bonds offering yields? I mean, at what point is there a contradiction here?
Well, let's look at the facts. I mean, who's pulling back fiscally? I mean, the US have just announced $2.7 trillion, of which 700 roughly is being channeled towards trying to get companies to join them with capex commitments. So I'd actually go the other way. And then look at Germany, of course, 11% of GDP being committed in fiscal spending. Now, Germany does have the fiscal space. So, yes, fiscal's a big deal. So I don't see a reason why we should be thinking about the economy going into reverse. In fact, I'd be more concerned if bond markets were actually seeing curves invert, because that's usually the signal that something bad's going to happen. So the steepening, to me, I just say hold your nerve. There's a lot of good reasons to be sticking with risk assets. Earnings are turning, sure, valuations are toppy, but generally firms are performing and they're delivering cash back to their shareholders.
So it sounds like you're expecting a re-acceleration in the economy. The US and Europe, the rest of the world, or specific regions?
Look, we're generally bullish on the outlook. The data that have come through in the middle part of this year, especially if we look at the soft data, of course, always forward-looking. Expectations have come down. Consumers are kind of not very happy about the world. But the reality is the US economy is moving along in a reasonable way. We expect the hard data perhaps to dip a little bit in the second half, but we do expect a reacceleration next year. There's regulatory easing to come, huge fiscal spending to come, but more importantly, it's capex. We see this capex story coming through strongly. And then look at Europe. We have significant commitments out of Germany, particularly out of the German corporate base, and we do expect spending to come through. Yes, there's political risks. This is Europe. There's always political risks. 20 countries in a bloc, average election cycle of 4 to 5 years. You're going to get an election every quarter. So we get used to the noise in the background. So there are these risks out there, but the underlying growth in the economy we feel is there, and we feel it's reasonably
If you're
robust.
a US-based investor, though, are you going to allocate towards those political risks in Europe or just keep the money at home? At the start of the year, there was a thought that maybe the money would go abroad. What about now?
Well, I think we've got to look at a couple of things because, we can't be bullish on everything. So the one thing that we do see as having some threat to it is the dollar. So if you're looking at the dollar potentially taking it on the chin as, fiscal experiments take place and dollar weakening some over the quarters and years ahead, which is our core expectation, you're going to get a currency tailwind. Add to that the fact the Fed are likely to be tilting more dovish, basically following the labour market, but also with changes of staff in the FOMC. ECB are pretty much done on taking rates down. And if anything, we've got this fiscal thrust coming through in Europe. So we'd expect euro dollar to have a fair value of somewhere around 1.25 over the longer run. So you get that currency tailwind. That removes one of the big impediments, I think, for international investors looking at Europe. And that's been the worry that they're going to underperform on the equity side and get hit with the currency. So you take one of those away. And bear in mind, since the Eurozone crisis, we've seen somewhere in the region of 400 billion of outflows from European stocks. We've reversed maybe a tenth of that. So to get back to a fair allocation, we do see some upside to Europe for international investors.
Your bull cases are sounding so bullish. We see some upside, understanding that there is always political dysfunction. It is Europe, after all. I just wonder how much the alternative is just gold. I mean, you talk about the idea of a weakening in dollar. You talk about this question of political dysfunction in Europe. How much do you see ongoing gains for gold, and is that the new reserve currency?
Well, I wouldn't go as far as to say it's the new reserve currency per se. It's probably the one that's the oldest we've got, apart from perhaps blocks of salt or cowrie shells. But the reality is, look, owning gold, it's been on a tear. And of course it's been on a tear because of the uncertainty, because of concern about debasing of fiat currencies. And I think that is a theme that's going to be with us for a while. So, we don't see pullbacks necessarily in gold. I'd watch the technicals and watch for crowding because, it's a market that can whip around very, very quickly. But generally, when we look at our outlook for gold, we're seeing returns well above inflation over the long run. So we would see it as having a sensible place in a portfolio for a long-term investor.
Amazing move so far this year, more than 30% higher for 2025 for gold, up again this morning by 31%.
Yeah, maybe blocks of salt and cockle shells will be next because maybe we'll go back to the old thing,
I don't have a block of gold, but I've got a block of salt at home.
Yeah,
in the kitchen, yeah.
Really?
Himalayan rock salt, just sitting on the side.
You totally do. You
nice
shave
slab
it,
of it.
and you absolutely shave it.
Just sits there looking pretty. You think I cook? Come on, Lisa. John, it's good to see you.
Good to see you.
Thank you, sir. John Bilton at JPMorgan.
Can I just say, what John just said there was they're not going to plan to cut back fiscal. What about those 2 holidays over in France?
Oh, in France.
Yeah, that's going to change everything.
I think he was talking about Germany specifically.
Yeah, but, there's going to be, a contraction in French holidays.
Still negotiating that, aren't we?
Yeah, well, let's see. That could actually change the financial picture.
Could do. You don't want to annoy the French. They protest quite violently. Particularly the farmers.
They're going to be picketing in the control room.
John's playing nicely.
All right.
Shouldn't joke about these things.
Sorry.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Johanna. Hey, Johanna.
Hi, John. We're seeing shares of Macy's soaring nearly 10% in the pre-market. The retailer raised its annual outlook and reported its best comparable sales growth in 12 quarters. It's the latest sign that consumers are still spending despite concerns about inflation and tariffs. Macy's now expects net sales of as much as $24 billion for the fiscal year, up slightly from its previous guidance. Meanwhile, gold's hitting a new all-time high earlier for a second straight day. Investors are boosting bets on an interest rate cut and using the commodity to seek safety from the sell-off in bonds and equities. Gold continues to be one of the best performing major commodities, having risen more than a third this year. And sticking with commodities, oil prices are slipping after Reuters reported that OPEC Plus will consider a fresh round of supply increases when the group meets this weekend. Most analysts and traders expected it to stand pat on production for October, pausing a long run of increases. So a surprise there. That's your Bloomberg brief. John?
Yohara, thank you. More from Yohara in about 30 minutes. Up next on the program, President Trump versus Governor Cook.
This really has nothing to do with the Fed. It has much to do with public officials. If you're going to be in charge of the Federal Reserve, damn, you better sure know how to fill out a mortgage application.
A conversation up next with Libby Cantrell of PIMCO, live from New York City this morning. Good morning. Equities bouncing back on the S&P 500, up by 0.5, on the Nasdaq 100, up by 0.7, thanks to these two names right here, Google and Apple. Some antitrust relief for Alphabet, and Apple will still get paid. Alphabet up by 6%, Apple up by 4% this morning.
Who's the biggest winner? On one hand, Google, which faces other existential crises, might live to fight another day with some of their applications. They don't have to sell Chrome. But Apple, and just to keep that $20 billion infusion going, can you imagine what it would look like if they didn't get that money on an ongoing basis?
It removes the hangover, for sure. But ultimately, as we've both discussed, the real risk for Google is from the competition, from the emerging competitors. It's not from the regulator.
My father is best friends with ChatGPT. I think
How's
a lot
that
of
going?
people, it's going really well, although maybe not for my mom, but I do think that it's really interesting to see that he ChatGPTs everything, and I don't think he's alone.
I'm not sure your dad wanted you to share that this morning.
Dad,
if you're
love
watching.
ya.
Okay. Under surveillance this morning, President Trump versus Governor Cook.
This really has nothing to do with the Fed. It has much to do with public officials. If you're going to be in charge of the Federal Reserve, damn, you better sure know how to fill out a mortgage application. And boy, it's awfully weird that she potentially saved a lot of money by making so-called clerical errors. Jerome Powell, he's got to answer for why he's not coming out and saying this is bad. He's destroying the credibility to the Fed by not saying that mortgage fraud is bad.
So here's the latest this morning. Federal Reserve Governor Lisa Cook's lawyer blasting President Trump's, quote, cut and paste allegations, saying she never committed mortgage fraud. For the latest, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Yeah, hey, John, good morning. So in this latest filing, we're really seeing Cook's lawyers double down on the arguments that we heard from them on Friday when I spent all day at the federal courthouse for the first hearing in this case. But they're perhaps putting a little bit more of a finer point on what they are arguing, that President Trump doesn't have sufficient cause to fire Cook. And we got really what felt like the most explicit denial to date that the allegations of mortgage fraud against her are not true. Now, I wanted to highlight 2 points that we saw in these filings. One is that her lawyers say that the mortgages in question were actually on forms submitted to the White House and the U.S. Senate during her vetting process, and that this all has to do with her private conduct before she was a Fed governor. We had heard during the hearing her lawyers argue that if there were discrepancies on these mortgage applications, it perhaps has to do with clerical errors and that Cook did not intend to deceive anyone. Now, you mentioned that copy and paste line. It does appear that her lawyers are trying to paint this as being politically motivated, like they have referenced how the administration led by FHFA Director Bill Pulte have highlighted these other allegations of mortgage fraud against officials that might not always agree with the president, like New York Attorney General Letitia James and California Senator Adam Schiff. Now, you ask the administration, and we heard a little glimpse of it there from the FHFA Director Pulte, but they're arguing that it is up to the president to determine what amounts to sufficient cause and that they actually gave Cook sufficient time to respond to the allegations. They point to the 5 days between President Trump calling for her to resign and then posting her termination on Truth Social, something that Cook's lawyers in these filings double down on does not amount to due process. John, if we really learned anything new from these court filings yesterday, it's really that we're not going to get a ruling on this temporary restraining order that Cook is seeking by the end of the week. And that's because the judge said that the administration now has until Thursday to give their own response.
Tyler Kendall with the latest down in Washington. Tyler, thank you. With us here in New York, Libby Cantrell of PIMCO. Libby, good morning.
Good morning.
September 17th. Will she be there?
Will Lisa Cook be there? I mean, we think so. We expect so. I mean, I think obviously this is how the court will adjudicate this is sort of anyone's question. But assuming that the court has not sort of definitively decided whether this is fraud, we believe that she will most likely be there. I think the bigger question in some ways is, will the Council of Economic Advisors Chairman Myron be there? He, of course, is going to be sitting for his Senate confirmation hearing tomorrow. We think that is quite aggressive. So Lisa Cook most likely will be there, again, sort of barring any sort of court developments. But Chairman Myron probably will not be there.
How much is it going to be a contentious fight with Stephen Myron in those hearings tomorrow versus just paving the way? Come on down.
Yeah, well, I think, and we've talked about this before. I mean, the Senate confirmation process is not necessarily perfunctory. I think the market sort of just assumes that whomever any president nominates, they'll likely get confirmed. And I think for in most cases that is true. But for this particular position and this particular context, we do think that any sort of Fed nominee is going to be really questioned by Democrats, of course, but also by Republicans. And remember that the first step towards Senate confirmation is through the Senate Banking Committee. And, that again might just sort of seem like a bunch of kind of mumbo jumbo, but it's actually very important because assuming no Democrats vote for, say, Chairman Myron for Fed governor, that means that he cannot lose even one Republican vote in order to advance to the full Senate floor. So tomorrow will be very important. We do expect that he will get confirmed, but again, probably not in this very accelerated time frame, meaning that he'll probably, the earliest he'll be seated for that FOMC is probably October.
The controversy over the Fed has sucked up a lot of oxygen and a lot of time, and I wonder how much we ought to be putting to the idea that we could be facing a government shutdown in a couple of days, and I will say, or a couple of weeks. And I say this at a time where globally we're talking about government dysfunction, how much it could be affecting some of the fiscal worries in markets. Are you expecting us to actually shut down again? I mean, is this actually a worry that we have to focus on?
Well, I think that the market is pretty desensitized because there have been so many head fakes around government shutdowns, around debt ceiling fights. And so I think it's sort of understandable that the market sort of inured to even this discussion. But we do think the risk for a shutdown is higher this time around than it has been in probably several years. And that's because just the friction between the Republicans and the Democrats, the requirement, remember that in order to fund the government, you need at least 60 votes in the Senate. That by definition will require some Democratic cooperation in the Senate. You may even need Democratic cooperation in the House as well. And just given that lack of comity, that friction, maybe an understatement, I do think that the Democrats may very well be willing to take the political risk and shut down the government. Now, what we've seen from an economic perspective, it doesn't really matter unless it is a prolonged shutdown. But again, I don't think the risk of that is necessarily zero, just given some of these sort of political dynamics.
The issue we've been talking about in the last 24 hours is very much close to home for you. It's in the bond market. For the team over at PIMCO. What's been amazing for Lisa, me and others on this programme is to see tariffs go from something that was bond negative in April to bond positive as we kick off September. How are you and the team thinking about that now?
Yeah, well, and I think actually in all of these things that we just were talking about too, I mean, from our perspective, really lead to what we've seen in the bond market, which is a curve steepening kind of bias. And that is something that we've been positioned for that really since the beginning of this year. Clearly, there might be even more room to run on this in terms of the concerns around Fed independence, the concerns around inflation, the concerns about a government shutdown. We think that all reinforces at least a steepening bias. But yeah, I mean, I think, again, this is the kind of where we think this is sort of our sweet spot in terms of being active managers, being able to find some value in the bond market. But again, all of these things that we speak up in terms of Washington really do reinforce this idea of a bond steepening.
How much revenue are they raising through tariffs at the moment?
Well, a lot. I mean, it's, to date, it's around, for fiscal year, it's around $150 billion. So there is, of course, a question of whether the government would have to return that money. I think that is an open question. Our view here is that this legal process that you all have been talking about will play itself out, will likely go to the Supreme Court. If that is adjudicated on a sort of a normal time frame, that means that we may not see a ruling until actually June of 2026. So the upshot for the market here is, even though there's a lot of noise back and forth around these tariffs, our expectation is that they stay on, at least in some form or fashion, for the foreseeable future. And then, of course, as we've talked about, John, before, the president has a lot of other tools. So if the Supreme Court decides in an expedited fashion that he cannot do this, we think that he will put tariffs on using some of these other levers that he has.
Libby, it's good to see you, as always. Thanks for being here. Libby Cantrell there of PIMCO. Besson talking about raising $300 to $500 billion a year.
Yeah, which is the reason why it's a bond negative if they aren't raising that revenue, because what is going to plug that fiscal gap?
Yields higher this morning by a single basis point. Coming up, Bloomberg's Jamie Rush as European bond yields hit multi-decade highs. Plus, we'll catch up with Danny with your morning movers with a look at Macy's up 10%. Stocks doing okay, positive by 0.4% on the S&P 500. Similar move elsewhere on the Nasdaq, higher by 0.64, thanks to the movement of two names, Apple and Google, which we'll get to a little bit later in a few moments' time. In the bond market, 2-year, 10-year, 30-year, just want to sit on this within 1 basis point of 5%. Twice in the last 24 hours. The 30-year yield coming back down to about 4.96, but hitting a bit of a ceiling on that front. This line in the sand, 5%. Still there. Yields higher by a single basis point this morning on 30s, on 10s up by a little more than 1 to 427.70. Things calming down, at least so far this morning.
You're right to point out that it's hit or just been below that 5% threshold several times in the past 24 hours, because a lot of people have pointed to technical aspects of this. That was the fear yesterday, that we were superseding some technical levels. Today, not so much, which is giving people faith that maybe we've kind of blown the top off in terms of the freak out, the sort of toxic brew of concerns that have been ongoing for quite a while. Maybe it's just settling down.
Do you think the concerns that were greater here in the States or greater elsewhere, in places like France, like the UK?
Well, considering the fact that France is facing a no confidence vote and a destruction of their government, in Japan you're facing also a similar potential removal of the prime minister, and in the United Kingdom, well, a lot of people have described it as something of a dumpster fire in terms of the fiscal picture and what the options are for Rachel Reeves. So you could say that it's arguably worse elsewhere. In the United States, it's a bigger market and it's a more global market, and it's facing similar types of dynamics. And so that's why people are lumping them together. But I agree with you. I think that they are separate stories.
I saw the UK not having its budget until the end of November. So all of the rumours, the speculation, the reports about all these different policies is going to continue now for the next 3 months potentially.
So how do they message that they actually are thinking of cutting the budget, right? I mean, because that ultimately is what a lot of bond investors and what you are arguing for. And there was a huge article in the Financial Times saying people in the market, and I thought, oh, they listened to John, talking about cutting expenses. But, you know, how much can they really propose that, given that that isn't popular for a lot of the politicians who are in charge?
They're going to do what they think is right. And ultimately what they think is right is putting up taxes. They actually going to cut spending? I don't think so. A lot of people in this market would suggest that they do. That putting up taxes is just going to keep on hammering this economy, which is the game we've seen play out in the UK over the last 12 months.
If they do, watch out for those bond vigilantes, because already they're lining up and they're saying, don't do that because we will come for you. And so let's see this sort of game of chicken play out in the UK bond market.
UK bond yields down by a couple of basis points. We'll come back to that story in just a moment as we count you down to the opening bell. 2 hours away with some single names, some morning movers. Here's Danny. Hey, Danny.
Hey, John. It's the two big movers of the day. It is Google and Apple, with a judge ruling that Google does not have to sell its Chrome browsers, nor does it need to end its revenue sharing agreement with the likes of Apple. Hence why you are seeing both stocks rise this morning. A much milder outcome for this Google antitrust case. Dan Ives at Wedbush, of course, has a colorful thing out saying that the government folded like a cheap suit, and the man certainly knows suits. So shares of Google up just under 6%. Meanwhile, we had some retail earnings out in the last 30 minutes. Macy's among them, up more than 12.5%. A really, really solid quarter. In fact, they saw their best comparable same-store sales in 12 quarters. It's been a turnaround story for them. They called the consumer more choiceful. That's the word that they used, but saying that they are flexible and can meet those demands from the consumer. On the other side of things, we also had Dollar Tree earnings, the discounter. Those shares falling 5 1/3%. Initially was a pop higher because they had a beat and a raise for the full year. The issue for them is it seems like there was some funny timing around tariff impacts. They logged a 20-cent positive EPS adjustment on what they said was tariff timing. Analysts looked at that and said, okay, the results maybe aren't as good, and they're just getting this artificial bump. Hence, you see shares falling more than 5%, John.
He knows cheap suits. Danny, get it right. Danny, thank you. Thank you very much. That was an easy one. Well, Danny, in about an hour's time. It was harsh, wasn't it? Okay. On our radar this morning, Alphabet shares rising in the pre-market. Some antitrust relief for Google. A judge ruling the company does not have to sell its Chrome browser. Google will have to share online search data with some of its rivals. That stock, as Danny said, is high this morning by close to 6%.
And you see also some of the shares of Apple also popping on the heels of this, because they're going to continue getting some $20 billion for putting Chrome and Google, their search platform, as the default on their devices. When you take a step back, the fact that the market is up because of these names highlights how much this market is leveraged to just a handful of AI-related names. And it really raises some of these larger questions about have we really fully inflated the valuations of some of these companies. Deutsche Bank analysts Adrian Cox and Stefan are putting out this series called The Summer AI Turned Ugly, where they look at all of the potential bear cases for AI. You're seeing that more as the entire market hinges more on these names.
Julian Emanuel looking for a number close to 8K in the S&P year-end next year. And he's got a big bet on AI. And he says this is going to be bigger than the internet. And it may well be. But what did we see happen with the internet? It was interrupted by a massive misallocation of resources, a boom and then a bust, before ultimately it concentrated the gains around a handful of names in the following 20 years or so. Are we going to see the same thing play out this time?
And how much does that depend on the adoption and how it is adopted in the other 493 and beyond stocks? It's the reason why I'm curious how a number of companies are implementing this, especially after that MIT study that came out earlier this year that suggested maybe the rest of the 493 aren't seeing the financial gains as quickly or as significantly as a lot of people were expecting.
Alphabet up by close to 6% in the pre-market. Here's the latest on trade. The president saying he's not looking to lower tariffs on India. The US doubling levies on New Delhi to 50% as punishment for buying Russian crude. India hopes to finalize the trade deal with the US later this year, potentially by November.
This is the why behind why we saw Modi going out with Xi Jinping and Vladimir Putin and talking about new alliances. It's almost as if they're being pushed to do so. They're being pushed to choose sides. And so it seems like President Trump is doubling down on this whole idea of tariffs that supersede what you're seeing on China. How do companies deal with this when they were thinking of moving manufacturing away from China to India? The fact that, yeah, exactly. I mean, how does this sort of shake out? It seems like a lot of companies are continuing with those plans, so expecting that to sort of ease.
I think there's an exemption for electronics, right, for Indian tariffs, but ultimately I'm totally there with you. And the epicenter for this is foreign policy, and it's Russia and the war in Ukraine. Clearly, and for good reason, the White House is upset that India is buying so much Russian crude, and that China's been a big piece of this relationship with Russia as well. And it's just pushing China and India closer and closer together, when only very recently we were talking about India being an offset to China. Things have been turned upside down almost completely.
What I'm watching is the flows in terms of trade between India and China. How much are those relationships getting solidified versus just simply optics? And that has been the big question in a lot of what's happened over the past 24 hours.
That's the latest on trade. Here's the latest on the Federal Reserve. So we're learning the Treasury Secretary, Scott Bessent, will begin interviewing replacements for Fed Chair Jay Powell this coming Friday. The Wall Street Journal reporting there are 11 contenders. Following the interviews, Bessent will present a final list to the president to have a look through.
Key question, what does the Fed look like post-Powell? And increasingly, a lot of people looking to a change in the reaction function. And I was talking about this earlier, that the team over at Morgan Stanley said after Jackson Hole, they changed their view for rate cuts because clearly the reaction function at the Federal Reserve has changed. They are going to opt for protecting growth and protecting the economy at the risk of faster inflation down the line. Seems to be what they're talking about this morning as well.
Is that what the replacement's going to do too?
Well, that's exactly it, right? I mean, is that what we're looking for, given the fact that that seems to be the tone coming from this administration?
Let's get to the bond market. This conversation has big implications for what's happening worldwide. European bond yields hitting multi-decade highs in the last few days. In France, the highest going back to the Eurozone debt crisis back in 2011. In the UK, the highest since 1998. And over in Japan, the highest on record. Joining us now to discuss is Bloomberg's Jamie Rush. Jamie, welcome to the programme, sir. Let's focus on Europe and the recent developments. Lisa and I have been talking about this for a while, whether these moves will force corrective action in France, in the UK. What are you and the team focused on?
Well, I think first we need to recognise, right, that there's a very big global component to what's going on with bond yields globally, especially at the long end. But you are, of course, right that Japan, that France, that the UK are at the epicenter of this. I guess one thing I'd point out, if we're thinking about how worried we should be about this, is that because it's so concentrated at the long end, and because we only issue, say, about 10% of our debt at around that horizon, it's not going to have an immediate fiscal consequence. So the imperative to start to respond to this isn't really going to be there. There isn't a really sharp market incentive at this precise moment, precisely because it's concentrated at the very long end of the curve. So I'd be thinking more about the longer term outlook for rates at horizons more like 10-year. And still, there's cause for concern, there's corrective action which needs to happen. But fundamentally, I mean, for some countries like France, there's nothing that can be done until the political situation is settled. And that's not going to be settled now. The fractious nature of the politics means that it may not be settled for quite some time.
There's a distinction to make, Jamie, as you point out, with the UK, because they have a majority in Parliament. They have the ability to do something. Do they have the willingness? And now we understand we've all got to wait until the end of November for the budget, Jamie. What do you suppose that budget is going to look like?
John, I'd be happy to wait even longer than November if that's what it took to get the UK back in shape. What should we be expecting? Well, look, let's think about what the big picture here is. If you think about what should the tax ratio look like in an economy? Well, it should look something a little bit like the old age dependency ratio. As your population ages, you've got to finance it somehow. You've got to finance the outlays. And if you look at a plot of dependency against tax ratios, you'll see there's a bit of room for the UK to keep moving higher with the tax rate. So ultimately, that, as you said earlier, is likely to be the way out. It's very difficult to secure a political mandate to achieve spending cuts. That's true in France. It's true in the UK. And so it points you in one direction. It's probably going to be tax rises.
Jamie, I know that the UK is in a different position than the rest of Europe, but can you lump together Europe and say that they're in a better situation than the US or a worse situation than the United States fiscally?
I mean, in aggregate, I would say that Europe is not looking too bad relative to the US. I mean, if you think about the size of the budget deficit, the difficulty in the political constraints in shrinking it in the US, I don't think Europe looks particularly bad on the whole. But of course, Europe is not a whole, is it? It's not a fiscal union. Germany looks solid. France, on the other hand, does not. And so we're going to see these pockets of risk intensifying until there's political clarity. And our view at Bloomberg Economics is that the fractured nature of the politics just means that that's not going to come into view anytime soon. So we're going to be looking at stopgap solutions, budget stopgaps over the coming year perhaps, that get us a budget or get us some spending continuing, but it's not going to be a resolution. It's not going to be a comprehensive fiscal plan by a long shot.
The reason why I ask that, Jamie, is because a lot of people had talked about how the United States and some of the concerns here were driving some of the dysfunction in the rest of the world. And as John pointed out earlier, actually, we're seeing the market protest dysfunction in places like Europe and places like Japan, almost more than what we're seeing in the United States, where there's the offset of revenues, whether it's from tariffs or whether it's from faster growth. Do you think that's a fair way to look at it?
Yeah, I mean, I think I can see it that way. And if you want to think of another factor, well, the US isn't going to have to ramp up defense spending in the same way that Europe is going to have to. So if you want another dividing line, then that's another one which kind of pushes you towards the US. But I don't think you can underestimate the degree of division across the House and the lack of political will in the US to tackle the budget deficit, irrespective of where we are now in the current regime or where we may be in 5 or 10 years' time. It's very hard to see that changing.
Jamie, appreciate your time. I have a feeling we'll be talking again soon. Jamie Rush there of Bloomberg out of London on the situation in Europe. You've got to wait a few months to get that statement from the Chancellor in the UK.
He said he'd love to wait if that really meant something that would actually turn things around.
I agree.
I think a lot of people would agree. The question is, will they actually engage with some of those spending cuts? And I do think it's notable that pretty much everyone in bond markets are saying, you got to do it. And they're saying, maybe we could just raise taxes a little bit right here.
The good news for this morning, at least, is yields are lower by 3 basis points or so. 30-year bond yields in the UK, 5.66. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Back with us, here's Johanna. Hey, Johanna.
Hi, John. President Donald Trump is calling out China's President Xi. Trump took to social media, posting, "Please give my warmest regards to Vladimir Putin and Kim Jong-un as you conspire against the United States of America." This comes as Xi hosted Russia's Vladimir Putin and North Korea's Kim Jong-un, as you can see there, for China's largest military parade. Meanwhile, Meta has poached more AI talent from Apple. The iPhone maker's lead AI researcher left to join the Meta robotics studio. And sources telling us here at Bloomberg, 3 more AI researchers are leaving Apple's large language models team. As we reported before, Apple is exploring whether to rely more on outside technology rather than homegrown models. And sticking with tech, Anthropic has closed a deal to raise $13 billion. This new round of funding nearly triples its valuation to $183 billion, making the AI company one of the most valuable startups in the world. Anthropic will use the new funding to meet growing enterprise demand for their safety research and accelerate plans for international expansion. That's your Bloomberg Brief. John?
Johanna, thank you. More from Johanna in about 30 minutes' time. Up next on the programme, the bond sell-off continues.
You have these policies that really are incompatible with lower inflation and with lower yields, and that I think is driving the market in the long end pretty much around the world.
A conversation up next with Greg Peters of PGIM, live from New York City. This is Bloomberg. Welcome back to the programme. Equity futures doing better, up by 0.5 on the S&P 500, up by 0.7 on the Nasdaq 100. A lift to this equity market so far this morning. Under surveillance this morning elsewhere, the bond sell-off continues.
You have these policies that really are incompatible with lower inflation and with lower yields, and that I think is driving the market in the long end pretty much around the world, and don't really know what's going to change that dynamic unless you get policy changes and or some sort of recession signal that actually pulls long-term yields down.
So here's the latest this morning. The 30-year bond yield coming within just 1 basis point of 5% earlier in the session. Greg Peters of PGIM Fixed Income writing markets are torn between the support from lower US front-end yields and the risk premium associated with unconventional policy. Greg joins us now for more. Greg, welcome to the programme, sir. Just to extend that quote, what do you think is the greater force at the moment?
I think it's the uncertainty. I think the term risk premium is the driver, and that manifests in many different ways. I've heard a lot of commentary throughout the morning, and it is a global sell-off, and there's different reasons behind what's happening in the UK versus the US. But ultimately, I think there is this risk premium function that's being priced in that's overwhelming what central bank policy is endeavoring to do.
Greg, as you know, over the last month or so, we've seen steepeners both in Europe and in the US. The steepener in the US has been more of a bull steepener led by the front end. In France and the UK, it's been more of a bear steepener led by the long end. Do you see reason for the long end in the United States to begin to participate in the same way we've seen elsewhere?
I do. I mean, the U.S. has been an outperformer in the back end. So we're talking about hitting 5%. But if you look at kind of throughout Europe, the curve steepened much more and is currently much steeper. So I think there's scope for the U.S. to catch up. I think the U.S. has outperformed for a few reasons. First and foremost is the tariffs, right? So, the bond markets are pricing in that revenue, at least a portion of it. It's unclear, one, if those tariffs will stay in place and what happens to that revenue. So it was more of a hedge. And the other is around kind of this notion or this belief that the Treasury will operate some kind of twist function, where, you look at the UK and in Japan, they've just, really hit the back end of the curve hard from a supply standpoint. Bond investors are a little concerned about putting on too much of a steepener trade, given the fact that you might see some change in the supply.
So, Greg, this is an issue of betting that the United States Treasury Department is not going to sell 30-year bonds nearly as much as T-bills, which we know is currently part of the plan. How much is this also counting on unconventional Fed policies and some Operation Twist as executed by the balance sheet in some fashion?
No, I think it's all related, honestly. But, let's be clear, Lisa, it is unclear. So we don't know. So we're just hedging our bets, as with everything. Uncertainty continues to rule the day. Kind of the range of volatility on the bond side, at least, has consolidated much less than where we were a year ago, 2 years ago, 6 months ago. So we are, consolidating. But at the end of the day, we just don't know, right? We don't know what the fiscal looks like. And I think that's important. And so the bond market's kind of playing that game. And we also don't know what Treasury intends to do with the forward issuance calendar.
So if I put this together into some sort of trade, Greg, are you buying European long bonds and selling the ones in the U.S.?
Yeah, so I think Europe looks attractive, right? If you look at it just on a kind of a fundamental basis, just forget the supply dynamics for a moment. The UK, there's been lots of chatter around the UK, of course, the past couple of days. But the UK actually does have a better fiscal position than the US, right? Just on a debt to GDP basis, and yields are substantially higher, right? And then if you look at it on a forward basis, US versus Europe, and I know Europe is a conglomerate of, different kind of fiscal situations, but if you look at Europe, there's, some fiscal decline potentially, but maybe not as much as the US. So, yeah, I actually see more opportunities outside the U.S. from a bond market perspective than I do within the U.S.
Greg, are we comparing apples to apples here, though? Aren't the fiscal concerns in the UK more relevant to the UK market than fiscal concerns in America are to the US market? We've often talked about this, the unique privilege America has of borrowing in the debt markets. Is it a relevant source of risk?
Well, I think that'll be tested over time. But if you look at it just on a pure basis from that lens, Jonathan, the U.S. is benefiting, right? If you look at it just, debt to GDP scatter versus yields or curve slope, the U.S. is sticking out in a positive way. So I think the question on the table is, will that remain? And I'm less sure about that, quite candidly. Not suggesting it's going to lose all of its privilege, but maybe some of it. And I think that'll be tested. That narrative will continue to be tested over the course of the next month, 2 months, 2 years.
Greg, just before you go, you mentioned favouring UK debt, maybe European debt more broadly. Are there pockets along the curve that you're more constructive on and other pockets that you would be hands off, you'd leave alone?
No, I mean, the long end's interesting. That's where the market has really sold off, and it's sold off for good reason. So I don't want to suggest that it's just a wave it in type of trade, but that's where the dislocation is, and I see more scope in kind of the intermediate to back end of the curves than I do the front end. Where in the U.S. it's opposite, where I see more opportunities in the kind of the belly and inward. So it's kind of a very different trade outside the U.S. versus inside the U.S.
Interesting. Greg, well framed. Interested to hear your opinion. Thank you, sir. Greg Peters there of PGIM Fixed Income on the latest in this bond market. The way that conversation started, I think has been really underplayed, not just recently, but through much of this year. Just how much outperformance we've actually seen in the US debt market relative to what we've seen play out in Europe.
Yeah, I was looking at the yield curve between whether it's 10s and 30s or 2s and 10s. And yeah, it's widened out in the United States, but just to the highest levels since a couple of years ago. It's not exactly this incredible steepening. And you could say it's because people are expecting a reacceleration in growth. Isn't that usually a positive sign for risk assets going forward? It's something we were talking about. At the same time, it does seem like the U.S. is subject to some of the same concerns overseas. So why has there been such an outperformance? The idea that Greg was saying maybe it's because of the tariff revenues really highlights how much there is uncertainty about the fiscal picture of the United States.
We're talking about real money, $300 to $500 billion of revenue every single year. Now, we can have a big debate about the source of that income and whether it should be coming from those places, but ultimately it's going to be supportive of the bond market. Honestly, and has been.
Honestly, I have no. I mean, people can come up with lots of different reasons, and I'll say yes, that sounds great.
That's what makes them mark.
Exactly, but right now, it's a very uncertain time.
Coming up on the programme, we'll talk about that uncertainty with Jitania Kandhari of Morgan Stanley. We'll catch up with Stefan Slowinski of BNP Paribas, Nancy Lazar of Piper Sandler, and Mark Cabana of Bank of America. The third hour of Bloomberg Surveillance up next.
There's a lot of negativity hiding out in pockets of the market that have not performed.
The outlook for the equity market from here is not really that robust.
You're really seeing this pivot and rotation.
You got to follow the tech stocks. If they go down, the market's going to go down.
For most investors, they're really levered to what's happening at the Fed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning, this is Bloomberg Surveillance. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equities on the S&P 500, positive by 0.4%, bouncing back, supported by Google and Apple. The Nasdaq 100 higher by 0.65 in the bond market, within 1 basis point of 5% at the long end of the curve in the last 24 hours. This morning, 495.93, and yields just a touch lower. Unchanged on 10s, 426.92, and lots of data still to come. Later on this morning, job openings, the drumbeat continues. ADP data tomorrow, together with jobless claims, and then payrolls this Friday.
Key question is, how bad does the data have to be to reintroduce the idea of a 50 basis point rate cut this month? And you might laugh and say, really, we're talking about that again? I thought we took that off the table. And yet Stephen Englander, actually, over at Standard Chartered, put out a piece overnight where he said, actually, if the non-farm payrolls report comes in with a headline number of 40,000, or if revisions come in really problematically, they could see a reason to cut by 50 basis points. And suddenly, you might see a huge rally in the global bond markets, and we could reverse this whole conversation.
Well, I can tell you the median estimate is 75, the low is 0, the new high is 144. So that's a pretty wide spread going into Friday.
And you could make that spread even wider when you start to talk about revisions and how accurate any of this data actually is and how much the market is going to look at that, which is a reason why we're all very excited about ADP and JOLTS today. Don't forget JOLTS. I'm very curious about job openings and the quits rate, which might tell us more, as well as the ISM subcomponents from yesterday.
So that's for July, and as we understand in July, things weren't tremendous based on non-farm payrolls. Much more interested in the data still to come and a forward look at things, because this market is pricing in a big snapback, a recovery, an acceleration in growth, reflected in and by what we saw in the equity market just last month. Home builders doing nicely, airlines doing nicely, small caps running aggressively. That's got to be supported by a rebound in the actual economic data. Let's see if we get it.
I have an economic data point for you.
What have you got?
The Beige Book. That is coming out later today. And I can tell you, I am very interested to see the Beige Book because it might give some commentary about how much companies are actually re-upping some of those investment plans. Although, of course, it can all be dated considering the court case and what that could actually do. But that is the key question. How much do you see a reacceleration in investment beyond just the artificial intelligence giants that have powered a lot of the index higher, even if we do get some questions around the underlying economy?
The good news is Chairman Powell's not going to wait. He already looks spooked. It looks like he's going to prioritize a little bit of front loading, a rate cut in September, regardless of what the data looks like between now and then, and potentially beyond.
And this is the reason why I think the bond market sell-off has spooked a lot of people. And you could say it's a global story, and you could say it's a real question of fiscal authorities kind of facing a lot of dysfunction. But there is a bias to allow inflation to run hotter. When you have Japan and their core CPI coming in above where the United States is for the first time in 40 years, you are talking about a new inflationary regime globally. And if the Fed's going to tolerate that, if they're not necessarily going to see that as the priority in terms of the concern, that introduces a new risk. Of course, in the break-even rates, you're not seeing inflation necessarily as a concern that's coming out, but this is what a lot of people are saying.
I hear you, Lisa. I'm totally there with you. I don't think anyone on the committee can look at you with a straight face and say they're targeting 2%.
I think that's correct.
Because if they think they are, they've failed. They've clearly prioritised the labour market. We saw that last year when they cut 100 basis points, and arguably we're seeing it again going into the September meeting.
If you look at break-even rates, people are saying 2%. The new 2% is something like 2.4%. And if you're targeting 2%, you say, I'll be okay with getting down to 2% in 2035 as long as we maintain unemployment rates at this level. That's a very different type of 2% target than during a period of time where it was getting inflation up to 2%, not down to 2%.
You know what the schedule looks like. Payrolls this Friday, then 6 days later on the 11th we'll get CPI, then the following week that Federal Reserve decision. Coming up this hour, over the next 60 minutes we'll catch up with Jitania Kandhari of Morgan Stanley as global bonds are facing renewed selling pressure. Stefan Slowinski of BNP Paribas as Google wins the antitrust battle to keep Chrome, and Nancy Lazar of Piper Sandler as we look ahead to jobs data throughout this week. We'll begin this out with the global bond market sell-off showing some signs of easing. Bond yields this morning just about stable in the States and in the UK. As for Japan, still very close to the highs on record. Jitania Kandhari of Morgan Stanley joins us now for more. Jitania, good morning. It's good to see you. Thanks for dropping by the studio. These global bond market moves, you seem comfortable with things. Things are okay. Are you more comfortable with what's developing in the United States versus what's happening elsewhere?
Yeah, I think there are two things for the bond yields in the United States, right? One is the fiscal and one is inflation, right? On the fiscal, I think there are offsetting factors. There is spending, there's some revenue coming in from tariffs. I don't worry excessively there. On inflation, it's important to keep in mind that though the goods inflation rates are going up because of tariffs. On the services side, inflation has been coming down. And things like rent are a big part of the core CPI. Wages, they are also an integral part of the CPI. So on the services side, you have inflation coming down. So I'm not so worried between the goods and the services inflation. You could have inflation rates of core PCE of 2.83%. So sticky inflation, but not a runaway inflation story that really...
Of course not, but this is ultimately what we're getting at. 3's the new 2, is it not?
It is, and I think based on that, if you look at where we are on a real rates and a 10-year, it seems like fair value. And if Fed were to cut rates, I think that's a high chance. 10-year always comes off when Fed cuts rates historically. So I'm not overly concerned on this run-up in yields. Markets tend to overreact in the short term, but I think based on the economics of the situation, we should be okay.
Well, does it really pull into question this idea of dollar depreciation, though? Because if the United States is dealing with inflation and yields that are going up, well, it looks less bad if the rest of the world is experiencing it and then some, and you see inflation actually running hotter in a place like Japan. So does this story necessarily come together with an ongoing depreciation of the dollar?
It's exactly the point. I think the worry is more on the dollar. So interestingly, from mid-April to date, the dollar's been steady, but you've had a depreciation trend and a counter-trend rally tactically in June to August. I think at this stage, the 2-year and the 5-year differentials, which is typically what drives the dollar versus especially the G3 FX, are now favoring ex-US. So you have that interest rate differentials actually helping ex-US, and the administration wants a weak dollar because that'll help deficits, that'll help trade competitiveness, that'll help the debt. So I think that continues, and that makes international assets appealing.
This, to me, is really a theme that's been throughout the morning. We've heard this from Jamie Rush. We heard this from Greg Peters. The buy Europe and the European bond story in the wake of the sell-off, more so than the long end of the U.S., because there seems to have been maybe an overestimation of political dysfunction and fiscal dysfunction in Europe. And right now, you're getting compensated for it there, while as you're not getting compensated in the United States. Do you agree with that? Do you think that things have gone a little bit too far outside of the U.S.?
I think so. I think the one thing to keep in mind is Europe now, the inflation has bottomed out. So I don't think ECB will cut rates. The other point is Europe, with the fiscal stimulus, is going to issue a lot of bonds. And I think there's more opportunity outside the US for the first time. Japan is positive, so there are bonds there to buy. And most importantly, I think the public-private partnership route that Germany is going to take in this process of the fiscal spending is also going to be an important piece of the overall infrastructure stimulus and the state-led industrial policy that seems to be the driving theme both within and outside the US.
Is this a story you have more confidence playing through equities, bonds, or foreign exchange?
A combination of two. We always look at asset allocation in entirety. I think, the 60-40, thinking about that again, but what in the 60 and what in the 40? I mean, emerging market bonds, local bonds look great. So I think you have to think about it having some store of values like gold or even some Bitcoin. It makes sense. And of course, looking at it across the asset allocation spectrum. I'd say one thing, that in US equities, the operating EPS estimates for the next 6 quarters is about 13% plus. Historically, I was looking at this, there's only a 7% probability of that kind of EPS momentum. So the bar is really high to meet that. Generally, it's about, on average, 8 to 9% operating EPS over 6 quarters in a row. So that is I think that is the more important point here with respect to the equity market, because you really need to meet those expectations.
So you have a preference for European equities, is that fair?
I have a preference for international equities.
Versus the US?
Versus the US. I mean, of course, this is not like boycotting the US. It's like, when all this dust settles, what do you want to own? Like, do you want to have 65, 70% in the US, which is the US weight in the index? Or with this view of the dollar, with economic traction in different pockets of the world, do you want to divert some of that and rebalance into some of these other economies? I think that's the stance we are taking.
You say some of these other economies, we've talked about Europe, but what about China? What about India? What about some of these other nations that are trying to form alliances and create economies outside of the Western alliance?
Yeah, there definitely seems to be like a Eurasian alliance brewing, and I think every country is going to do that to diversify its trade and relationships and hedge themselves. Lots of these countries have initiated reforms. India, I think that's kind of overdone in terms of the sell-off and the concerns because the impact on GDP is not that much. I mean, maybe it shaves off 30 to 50 basis points, but it's a domestically demand-driven economy with domestic liquidity. China with it's a tale of two Chinas, right? There is the old China, which is over-indebted, state-owned, and where there is excess capacity, dragging down productivity. That's not the area to be really backing. But there is the new China, we call China 3.0, with the AI, with DeepSeek, with how all of this is going to get embedded on the consumer side, especially because China is a very digitized economy. And there are a lot of opportunities in that space as well. So there's a lot going on in the rest of the world that merits attention and investments.
Well, thanks for shining a light on it. It's good to see you. As always, thanks for dropping by. Jitania Kandhari there of Morgan Stanley Investment Management. If you are just joining us, welcome to the programme. Equities bouncing back this morning by 0.5% on the S&P. So bond market jitters in the last 24 hours. We can tell you things are calming down just a little bit stateside and elsewhere as well. Bond yields in America on a US 30-year just about unchanged so far this morning, Lisa, short of 5%.
Yeah, and the fact that it hasn't been able to really cross and sustain above that 5% level is telling. I think it's interesting that this morning, so far, a number of different guests have said the sell-off in European bonds and Japanese bonds, although Japanese bonds maybe less, but European bonds looks more overdone than the one in the United States, where the U.S. has actually been outperforming on the long end versus the rest of the world. That is interesting to me. The ex-U.S. story coming back, that's a theme.
There's been some real resilience in the U.S. debt market. I think it's surprised people. I understand why they're looking now over at Europe and the debt market in the UK and France. Look, I wouldn't understate the difficulties that the UK and France are going to have addressing this problem. And we've seen repeatedly bouts of this, where the market's going to test France repeatedly, and not much has changed. Similar story in the UK. And yields, unfortunately, are still going up and to the right. And unlike equities, that's a problem.
It was a problem for the Liz Truss moment because of the speed. This time we've superseded those levels, and people say it's still under control. We'll make noise about possibly doing something, but wait until November. At what point are authorities going to be prompted to actually make some hard decisions? It seems like not yet.
It's relentless. 30-year in the UK, close to 6%. I'm not going to downplay that. That is getting closer and closer to a big problem. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Johanna. Hey, Johanna.
Hi, John. We start with that big win for Alphabet. Shares are rising 6% after a judge ruled the search giant won't be forced to sell its Chrome business in a landmark antitrust case. Google will, however, be required to share online search data with its rivals, and moving forward, it won't be able to make contracts exclusive, but can still pay other companies to feature Google products or use them as a default. Meanwhile, Fed Governor Lisa Cook's lawyer blasted President Trump's move to oust her, saying his accusations are based on nothing more than cut and paste allegations of mortgage fraud made on social media. He doubled down on arguments he presented last week, saying that Trump lacked valid grounds to fire Cook for cause. Meanwhile, we are seeing Dollar Tree shares falling 3.5% after the discount retailer disappointed investors by saying profit in the current quarter would be little change. The update overshadows the chain, boosting its annual outlook by 2%. Dollar Tree now braces for a tougher second half of the year after benefiting from consumers seeking out lower priced goods. That's your Bloomberg Brief. John?
Johanna, thank you. Appreciate it. Up next, the morning calls, plus Stefan Slowinski of BNP Pariba as Google wins the antitrust battle to keep Chrome. That conversation up next. Live from New York City this morning. Good morning.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets. Going back to Y2K, we've seen a series of asset price inflations. I won't call them bubbles because this is not a bubble in our mind now.
That was Julian Emanuel of Evercore looking for the S&P 500 to grind higher close towards 8K on the S&P 500 by year end next year. This morning already, an upgrade this time from HSBC for the second time in about a month. They lifted their price target to 6,400 on the S&P in August. It's now 6,500, which is basically, Bramo, where we are right now.
I feel like this is mark to market, and that's what we've seen all year. It was brought down, then brought back up. And even Julian Emanuel, who's so bullish for the end of the next year, is raising his price target for the end of this year to something like 62.50, which is below where we are now. So it just shows how fast we've gone.
Playing catch up, the rally continues. We're bouncing back by 0.5% on the S&P so far this morning. That's the price action. Let's get you some morning calls with one name in focus, Alphabet. First up, JPMorgan raising its price target to 260, saying the court's ruling was much more favourable than anticipated. The second call from Wedbush raising its price target on Alphabet to 245, saying the ruling was a monster win that removes a huge overhang from the stock. And finally, Citizens JMP raising its price target on 250 and maintaining an outperform rating, saying the ruling is a best case outcome for the name. Joining us now to discuss is Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning, sir. The stock is higher by 6.5%. Let's just start with your initial take. How favourable was this for Alphabet?
I mean, Chrome has so much strategic value for Alphabet that when you think about, generative AI, this is the priced asset that everyone wants. Even OpenAI and Perplexity, openly bid for, being a buyer of Chrome. So,
do you think that helped them?
I certainly think it did, because what it shows the judge, and it was evident, from the time he had the hearings to this remedy phase, where competition in Gen AI is far more than traditional search. And if you look at the 230-page filing, I mean, half of it is AI chatbots and LLMs, and how, competition has increased. So there is an acknowledgement that clearly things have changed, and that's why I think they didn't go with the Chrome divestiture, which was on the table initially.
Is Google doing enough with Chrome to compete with the likes of OpenAI? Isn't that the bigger question, rather than just simply the antitrust case?
Well, they weren't doing, I think, before because of the antitrust case. Now that this is past it, I think they would try for more deeper integration, because think of it this way. If you want a good AI agent, where would you type your query? It's that Chrome browser bar. Like, you don't even want to go in the app and type your query. There is still friction. You can minimize the number of clicks just by doing everything in the browser search bar. And so from that perspective, Google has the data advantage. They may have to syndicate. I mean, that was part of the ruling as well, that they may have to syndicate some of the data. But Google has so much data, user data, live data, local data, that, okay, what do you syndicate? And so from that perspective, the family of apps is what gives Google the advantage, along with the infrastructure, and Chrome is where they interface with the customer. So from that perspective, this is really a big positive for Alphabet.
Mandeep, stay close. I want to bring in Stefan Slowinski of BNP Paribas Exane, who's keeping a neutral rating on Alphabet with a 187 price target. Stefan joins us now for more. Stefan, welcome to the programme, sir. I just want to build up on some of the things that Mandeep was talking about. This sharing of data, can you shine a light on that just a little bit more? How much will that be an advantage to some of the competitors of this company?
Yeah, good morning, Jonathan, and thank you for having me. And I think that's going to quickly become the question going forward. Certainly, the ruling that Chrome will not have to be divested is positive. I think that was always seen as a tail risk and not a natural solution here, but still, it was a tail risk, and that can now be removed. But now we need to think about Google opening up some of its search data to competitors, to these qualified competitors. So that's going to now include the likes of OpenAI and Perplexity. It'll be interesting to see which of the big tech competitors take the government up on that offer. Will we see Microsoft? Will we see Meta? Will we see Apple? Will they start to potentially see this as an opportunity to take another shot at search? There's a ticking clock of 5 years to be able to use this data to improve the long tail of search results. That's kind of where some of the AI chatbots have struggled. And so we'll see if they can include that data to improve those outcomes and catch up with Google in more traditional search queries.
Stefan, to Mandeep's point, how much does Chrome or Google have already what they need to generate real artificial intelligence infused responses to the queries in short order after this court case to compete more effectively with the likes of OpenAI?
Google already has everything it needs. It has the most complete tech stack in the industry. Everything from the proprietary TPU, their own GPUs that they have, the large language models with the Gemini family. They literally invented the transformer model and were the founders of these large language models, into those 15 different apps that we were just talking about with 500 million users each. They also have, I think, a culture of innovation and execution, which they probably don't get enough credit for. So they already have everything they need. Maybe they feel like this gives them the green light to continue to better integrate all of those services and try to more forcibly take their market share in traditional search into AI. But also, as we've already seen, they are still behind in terms of consumer adoption. At the end of the day, ChatGPT has 700 million users. And when you look at AI search, you still have ChatGPT and others competing very aggressively with Google. So there's still a branding issue that Google needs to catch up on here.
How much of a discount still remains in Alphabet shares? Because a lot of the legal challenges aren't over. We've already heard from the Department of Justice that they're going to take the fight further, and there are other avenues that they are approaching.
Yeah, so let's keep in mind that Google shares have rallied 20% just in July and August going into this announcement. So I think investors were thinking or hoping or betting on a favorable outcome. You're still trading at around 20 times earnings, around a 10% discount to the historic average. So maybe we see that gap close a bit further. There are still some overhangs. You still have the AI uncertainty overhang about disruption in potentially the business model and clicking on blue links and disruption from new competitors. You still have an overhang for corporate communication. It's a company that doesn't provide guidance, that doesn't interact much with the street. You still have a little bit of an overhang on the regulatory front on the ad tech side with another remedy trial starting later in September. So there are still overhangs, but I think you could see the discount to Meta, which is trading on 23 times, continue to close as Meta begins to struggle with their own Gen AI efforts and as it looks like Google's getting their act together on their AI capabilities.
And Meta has thrown a lot of money at it. Stefan, appreciate your time. Stefan Slowinski there of BNP Paribas Exane. Thinking of overhangs, the biggest overhang right now has got to be the most obvious one, that more and more people are gravitating towards using ChatGPT over to using Google search.
Yeah, as Mandeep was saying, though, if you could just type it into Google search and get that same sweet voice whispering, responses to you in the evening, then maybe that reduces the friction of going to a separate app of ChatGPT.
This about your dad's relationship with ChatGPT again?
All I know is that it dominates our conversations.
What is going on over there?
All I can say is it gives us all the answers, so it's really
I've heard
an
some of those
enjoyable part.
stories.
Yeah.
People build some real companionship with.
I mean, I don't want to throw my dad totally under the bus.
Well,
It's just like an evening conversation. We often have ChatGPT at the table with us.
Mandy, you want to avoid this one. It's good to see you. Thanks for dropping by. From New York City, up next, Nancy Lazar of Piper Sandler. Stocks are bouncing back up by 0.4% on the S&P 500. There's still a lot of bulls out there. Julian Emanuel of Evercore on the program earlier, looking for 77.50 on the S&P by year-end next year. Max Kettner, HSBC, overweight stocks, saying he's seeing signs of a growth reacceleration. Savita Subramaniam of Bank of America, positive tail risk is still underappreciated, especially in light of a potential sales recovery. It's the rebound a lot of people are looking for.
And we heard that from Macy's this morning with the back-to-school sales, that they're really seeing people come back and really buy. Question is, how broad-based is this? Is this just investment in AI, or is this a broader reacceleration in the economy that can support other aspects of the market? Because we do still see the ISM manufacturing in a downturn, in a contraction territory.
How disruptive will this bond market be? Let's switch up the board and turn to fixed income. 2s, 10s and 30s. Bond yields so far this morning stabilizing, settling down up a single basis point on 10s and just about unchanged so far this morning on 30s.
It depends whether you see this as a good thing or a bad thing. Some people look at this yield curve steepening, the idea of the longer end selling off more, as a positive. Essentially, we wanted a positive yield curve for a long time. It indicates accelerating growth. Other people say this indicates a reacceleration or a volatility in inflation, which it is. Go figure. All I know is that pretty much everyone who comes on the show says that they're buying 1 to 7 year, and out the curve is a little bit more dicey, and that seems to be the trade of the day.
I think it's fair to say that the moves we've seen in the UK and France, that bear steepener, is not a reflection of improving growth. It's more of a reflection of the dire situation politics are in and their ability and willingness to deal with the fiscal situation.
And you put it really well. In the United States, is there a feeling that the bond market is somewhat divorced from the fiscal situation that is equally dysfunctional in many ways, and by some metrics even worse, but where there is the growth backdrop, there is the AI promise, there is the privilege of acting recklessly with the dollar as a reserve currency?
Look, for all the freak out that we had back in April about investors potentially dumping US assets, I think we've got to highlight the fact that US debt has been remarkably stable in the face of what's happened elsewhere. Just chart 10s and 30s, eyeball it. We're not seeing major moves up and to the right like we are in the UK and France.
And I've gotten several messages this morning as we talk about investors buying Europe over the US, saying not a chance. I am going to buy the US because it will continue with the most strength. So I've gotten just as much pushback as we have calls on the other side.
Yeah, it's going to take a lot for that to change.
I mean, there's a lot of structural buying, and there also is a question of, institutions in the U.S., and there's a huge consumer base, both from investment as well as actual consumption.
Some buying this morning. Stocks are higher by about 1/3 of 1%, rolling over just a little bit with 60 minutes. Less than 60 minutes to go until the opening bell. With your morning movers, some single names. Here's Danny Berger. Hey, Danny.
Hey, John. This market getting a big helping hand from Google this morning. Alphabet shares rallying up 6.7% after avoiding the harshest of punishments for its antitrust case. It won't have to sell off Chrome. And as part of that, it can continue its revenue sharing agreement with Apple for making Chrome its default browser. So that's why you're also seeing Apple shares. Those are up 3.5%. As Lisa mentioned, we did get Macy's earnings about a little over an hour ago, about an hour and a half ago. A beat and a raise. Strong results from Macy's showing that the consumer is still getting out there and buying a company which has had to engineer a turnaround. Shares are up 13.7%. I will just note that they did say that the consumer, especially going into the second half, is looking more fickle and more choiceful. That choiceful consumer also leading to problems for Dollar Tree. Those shares down 5.5% this morning. A beat and a raise, but the problem for them was their raise was for the entirety of the year. The current quarter that we're in, there appeared to be some weakness or at least some disappointment. They said that the third quarter is going to look much like the same as the prior third quarter. A little bit of weirdness of timing on tariff issues and the addition that's had to their earnings. So shares there falling off the back of that, John.
Danny, thank you. Thanks for this morning. Look out for Danny Berger alongside Matt Miller in about 25 minutes' time for Bloomberg Open Interest at 9 a.m. Eastern Time. So that's the situation with single names. Let's turn to the economy. The next read on the labour market is just around the corner. Jobs data coming at 10 a.m. Eastern Time ahead of the highly anticipated August payrolls report due out on Friday. With the latest, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, I was just talking with Mark Cabana in the green room about how we're going to be looking at JOLTS and we're going to be looking at ADP because there are a lot of concerns about whether or not the job market is slowing, and everybody wants alternate data. I do want to push back on the idea, though, that the bond market or anyone else should go into Friday's labor market report thinking that there is something statistically wrong with it because of what the president has said. My beautiful chart to show this isn't working. But basically, we had 253,000 jobs revised away at the last report. In January of 2024, we had 234,000 revised away in just 1 month. So it can happen. It's not unusual. Here's the problem. What we're seeing is fewer people, fewer businesses responding to the BLS surveys in the first month. But when you look out at the final revision after 2 more months, the response rate hasn't really changed. So it's not that people aren't responding, it's that they're responding more slowly. Look at March 2025. We don't have the April revisions yet. 42.6% for the initial, but 94% basically for the revision, not very different from what we've been seeing in all these other years. So the data are going to be as good as they can be and statistically accurate as they can be after the first revision, or second revision. So you can go into it with some confidence in what the BLS is telling you is accurate at the right time.
Mike, there will be a conversation, of course, about how to improve it. How would you improve it? What suggestions would you make?
Well, there are a couple of things that people have suggested that be done. One is that you could try to make responses mandatory, although that is a lot harder to do. The BLS has been working on trying to get more people to enter their numbers electronically. That could be done. And then maybe increasing the survey size or increasing the frequency of the surveys so that they get these revisions more quickly are other ideas people are talking about. And then, of course, the standby is give them more money so they can update their computer systems and get all this working more quickly.
That's one way of doing it. Mike McKee, thank you, sir. Appreciate you breaking that down. Michael McKee there of Bloomberg breaking down the labour market data still to come this week. Nancy Lazar, the chief global economist at Piper Sandler, is bracing for a soft employment report on Friday. She joins us now for more. Nancy, good morning.
Good morning.
What's a soft employment report on Friday?
Well, we're assuming about 80,000. That's maybe a little bit more than consensus, but as of now, 80 is our best.
Isn't 80 good these days?
Probably 80 is better than something closer to zero, to be sure. But it is a very, very clear shift down, and you see it in a lot of data. Companies aren't hiring. You see that in continuing claims. They're not firing aggressively. Initial claims are still relatively low. Your point earlier on the quit rate. The quit rate is coming down. People are reluctant to leave. And just ask consumers. I mean, the Conference Board survey of is it hard to get a job or is it easy to get a job is a metric I've used my entire career. And consumers say it is hard to get a job. So there's clearly been a shift down in the labor market. Why? Companies are trying to protect their profit margins.
Is 80,000 an even worse number because of the downward revisions?
Yeah.
To Mike's point, that the longer you wait, the more unclear the data is in the short run, but longer term, you do get just as clear of a look in terms of responses.
So the household employment data, which comes out with the unemployment rate, actually historically at turning points is better than payroll. I've studied this again my entire career. It was first written about in the 1970s. Unlike payroll, the household employment data aren't revised. There's a once-a-year population adjustment, but you can smooth that out. There's been no growth in the household employment survey for the past 12 months. And then on next Tuesday, you're going to see the QCEW, the quarterly census of employment and wages. And that's going to likely show a very sharp reduction in payroll from March of 25 back over the past year of about at least 800,000. That is, payroll is going to start to look more like the household data. Consumers know it's a weak job market. They're cutting back on highly cyclical stuff, both on the goods side and on the service side. So the idea that you're getting new news from the payroll report to me is a little misleading. Consumers have already reacted to this weak employment backdrop.
When does this churn become a problem? Because it's not a downturn. It's not a downturn yet. And it doesn't seem to be heading toward any kind of recession. But this low hire, low fire dynamic has continued and people don't feel very good. But companies are doing just fine, as we see in the earnings. So when does this become a problem?
So that's so important that companies are doing well in this environment. Before you can see an upturn in the job market, companies have to make money. That's been a beauty of the U.S. economy over the past decades, that companies are allowed to stop hiring and or in some cases fire people so they can rebuild their profitability, and that then gives them the ability to hire people. So I think some of the most bullish news for employment in 26 is the fact that 2Q S&P earnings came in double what they were supposed to have been and hit a record high. Prior to every upturn in employment growth, you first need an upturn in earnings and profits, and we're seeing it. So kudos to American companies.
Is that what you're forecasting now? A rebound in economic activity?
We are. This year, you're 1.5%, but you're already seeing capital spending turn up. Individual companies are seeing it. You saw it in the new order data yesterday. Why is that happening? Well, the Fed cut rates 100 basis points a year ago, and it takes about a year for that to work through the system. Second, you do have this full capex depreciation, which is the most significant capital spending booster shot since Reagan in the early 80s. You're seeing it in company data. So we have 3% GDP growth next year, and we don't think 3 is the new 2. We think next year inflation does shift back down to 2%. You'll lap the tariff increases, and you'll also see further acceleration in productivity, slowing unit
That's a
labor
great
costs.
setup. You're looking for 3% GDP, 2% inflation. Where's the Fed in all of that?
We don't need an aggressive Fed in this cycle.
You might get one.
That would make me worried about inflation in the back half of 26. You have stronger potential GDP growth, which is about 2.5%. Fed funds are pretty much in line with that. Nominal GDP growth of about 5%. Fed funds are a little bit lower than that. The problems of the 70s happened because the Fed would shove rates down way below nominal growth, creating a boom and then eventual bust cycle. And so we think maybe one cut would be healthy. But more than that, I would then start to worry about inflation.
OK, let's take a beat. Nancy, new Fed chair, comes along. Huge selection process. And they're going to deliver one cut in 2026.
Again, if the economy is if you go back and look at the 90s, which is where we think there are echoes of the 90s, the tech obviously strength in the 1990s. Greenspan in 95, I believe, cut rates just once. And you had 3.5% GDP growth with inflation slowing. You didn't need a lower interest rate environment because you had healthy potential GDP growth, stronger productivity growth, and very strong corporate profits. And those were the things that were driving growth, not lower interest rates. Again, that creates problems like another house price bubble and or a boom in nominal GDP growth, which then opens the door to inflation.
How has artificial intelligence changed the nature of that rebound, given the fact that this isn't necessarily going to be a job-full recovery that can be equally distributed to a lot of different people in different sectors?
So under the hood, there's always creative destruction in the employment data. Just look at the retail data when Amazon came on in the 1990s. You decimated retail employment in certain sectors, online touched sectors in particular. But at the end of the day, overall retail employment rose. And so creative destruction within the job market has gone on, not just back in the early 1900s, but even over the past 10, 20 years. Tech employment has not been a driver of the employment cycle. So I view AI as more of a productivity-enhancing, profit-boosting mechanism that actually is going to create more jobs because companies are going to have stronger earnings.
You're using it, and you love the Beige Book. Yeah. Can you tell us what you're doing that you think actually how it affects your job?
Well, for us, my colleagues are very talented, and using ChatGPT-5, you can actually write code for the Beige Book and get a sense of what the direction of the economy is from AI. So I'm a product of technological innovation. I started with a typewriter, obviously, then I went to a computer, et cetera. I'll stop. But technological innovation in this industry is not new. It just improves our ability to do, but hopefully, not always, a better economic outlook.
And Nancy, this was great. Appreciate your time.
Thank you.
As always, Nancy Lazar there of Piper Sandler with some pretty punchy calls for 2026. 3% GDP growth, 2% inflation, and maybe only one interest rate cut from this Federal Reserve. I don't think that's going to get you the job if you walk into the White House later this year and say you're going to cut rates maybe once next year.
This is something that nobody is pricing in right now, or very few people. Nancy is, but very few people in the market, because that does seem implausible politically. However, if growth is that strong and revenues are that strong and that keeps the 10-year and the 30-year down, maybe you could have a different conversation.
That bond market stabilising just a touch so far this morning. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Johanna. Hey, Johanna.
Hi, John. The U.S. Treasury Secretary Scott Bessent will start interviewing candidates to replace Fed Chair Jay Powell this Friday. The Wall Street Journal is reporting that Bessent will talk to candidates either in person or by video conference. There are 11 contenders for the job, and Bessent plans to recommend a final list to President Trump. Meanwhile, we are seeing shares of Macy's rising 13% in the pre-market. The retailer raised its annual outlook and reported its best comparable sales growth in 12 quarters. It's the latest sign consumers are still spending despite concerns about inflation. Macy's also raised its full-year net sales guidance to as much as $21.45 billion, with the CEO saying this is the beginning of a momentum change at Macy's. And at the U.S. Open, Novak Djokovic will play Carlos Alcaraz in a blockbuster semifinal round on Friday after the Serbian defeated American Taylor Fritz last night in a close match. And number 4 seeded American Jessica Pegula heads to a Grand Slam semifinal for just the second time in her career. She will face Aryna Sabalenka tomorrow. That will be a rematch of last year's championship, which Aryna, of course, won. That's your Bloomberg Brief. John?
Johanna, thank you. I just get the feeling if Sabalenka turns up for anything, she wins. If she turns up.
Well, isn't that true with any of us? Actually, no, not at all. not that kind of level of tennis. But yes, she is incredibly good. But I was actually I watched the game. I know what you're talking about with the Osaka versus that particular game, and
sure, yeah.
I'm interested in some of the other games, not just the, stuff like that.
Okay, good. All right.
Anyway, this was great.
Thanks for that. Up next on the program, I think. Let's set you up for the day ahead. No tennis. Plus, Mark Cabana of Bank of America joins us to talk about this bond market from New York. You're watching Bloomberg TV.
There might be even more room to run on this in terms of the concerns around Fed independence, the concerns around inflation, the concerns about a government shutdown. We think that all reinforces at least a steepening bias. All of these things that we speak up in terms of Washington really do reinforce this idea of a bond steepening.
We've seen a lot of that, not just in America, but around the world. That was Libby Cantrell of PIMCO. The good news in the bond market so far this morning, things have settled down. In the equity market, we are firmer by about 1/3 on the S&P 500. The opening bell just around the corner. As for the week ahead and the day ahead is shaping up as follows. At 10 a.m. Eastern Time, durable goods and JOLTS data. At 11 a.m., Poland's president visits the White House. Look out for that. At 2 p.m., the Fed Beige Book. Plus tomorrow, ADP, another round of claims, and a Senate hearing on Stephen Miron's Fed nomination. And then, of course, the big one on Friday, the payrolls report just around the corner. Just to stay on the markets, global bonds continuing to sell off, particularly here in the United States over the last 24 hours. Things settling down, though, over the last morning or so. The 30-year bond yield coming within just 1 basis point of 5%. In the last session. Mark Cabana, the head of U.S. rate strategy at Bank of America Global Research, is with us around the table for more. Mark, good morning.
Good morning.
It's good to see you.
Likewise.
A lot's changed. What's changed for you?
So we think that investors should really be focused on where the cutting trough in this cycle is. That's still around 3%. The Fed thinks 3% is neutral. The market seems to believe that that's credible and that the Fed will head there. Increasingly, at least for our rate strategy team, we see 3% as almost a cutting ceiling. They're going to at least cut to there, we think. And we think that the market is not fully appreciating the potential range of outcomes below 3% that the Fed could take us to. And that range of outcomes we think exists because you do have a moderating labor market. You do have inflation that is expected to peak around the end of this year or first half of next year. But we also think that you're going to have a composition of individuals at the Fed that are going to be targeting potentially different objectives than the current Fed is. And specifically what I mean by that is think about, let's say, how the Fed judges the natural rate of unemployment. The Fed thinks that in the longer run, this level is 4.2%. They don't know that for sure, but that's their estimate. What's to stop a new composition of Fed officials from targeting a potential 3.5% or sub 4% type of natural rate of unemployment? And we think that you're going to increasingly hear these types of arguments from individuals that are being considered to adopt leadership positions at the Fed. I'll certainly be listening for that on Thursday with Miron's testimony because we have heard from other, let's say, Fed chair contenders that they're open to this idea. And if the Fed does indeed adopt that type of approach, that opens up the range of outcomes for where the funds rate can go well below 3%. We think you want to be received 5-year OIS to benefit from that. It also means that you should be expecting that longer run inflation expectations move up. Because they are still very well anchored. We agree with the Fed's assessment on that. We think that they can be moving up. We think that the inflation curve can be steepening. And we think that the nominal curve should also be steepening in that type of environment. Finally, we like being short 30-year asset swap spreads because we do worry about some of this supply-demand dynamic at the back end of the rates curve. If the Fed is, let's say, cutting to rates lower than what many of us would think are justified by fundamentals today, who's going to buy the bond? If you're worried about upside inflation risks and the deficit is still not improving materially, who's going to take down all that long duration treasury supply? So we think you want to be positioned for that. And we like being short 30-year asset swap spreads to do so.
So as you talk, I'm thinking I'm going to hide in gold. I'm going to hide in the most pro-growth stocks because essentially they're going to juice everything. I mean, essentially, isn't what you're saying really positive for stocks, really positive for gold, terrible for the dollar, and don't even touch that 30-year bond?
Yes, 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 yes.
Okay, so that's basically what you're looking for right now.
And we just think that, again, you can focus on fundamentals. And fundamentals and our economists, and kudos to them, are still very much rooted in that. They're thinking this is an economy that's not headed into a recession, where you've got stagflationary risks, where inflation is going to be 3% or higher by the end of the year, and where the Fed is running the risk of a policy mistake by cutting later this year, if that's indeed what they do. And so they're thinking, why would the Fed be doing this? And I understand that from a fundamental perspective. But we've all seen the headlines. We've all seen, at least, or we've heard some of the approaches that individuals who are being nominated or considered for Fed leadership positions are espousing. And all of those, at least to me as a rate strategist, say, why are they going to stop at 3? Why would they do that? Waller is just saying, no, we're going to cut to neutral, or I think we should be heading to neutral, and I think neutral is 3%, but he'll be the first to tell you that he doesn't know where neutral is. And then once you start to contemplate some of these other arguments, we suspect, about lower natural rate of unemployment and really strong GDP and deficit financing levels, which is not in the Fed's mandate, but certainly you hear that line of argument from administration officials. Once that creeps into the dialogue, then why would they be stopping at 3? So we just think, again, that the distribution of rate outcomes is much greater to the downside than what the market is currently pricing. Not necessarily due to fundamentals, but due to a shift in the approach for how the Fed will likely be thinking about setting monetary policy.
You know, I give you a lot of credit for trying to force people to think outside a conventional framework, because I think that what we could see next year could be very unconventional.
The idea of targeting something sub 4.2% on the jobs market and ignoring the inflation possibility. I'm just thinking, I mean, I understand why people are pro-risk in that environment, because why wouldn't you be pro-risk at a time where they're trying to juice growth at the expense potentially of inflation?
No, we've got to run.
I do
We're
think
against the clock. 15, 20 seconds.
Okay, so what stops this? We think two things stop this. Number one, popular discontent with inflation, the voter. But I don't know about you. I would imagine that it takes above 3% inflation to really bring individuals out to the ballot box on this issue. 5. Or 2, loss of control on the back end. And you're going to be looking at best in cutting auction sizes in that event, or potentially the Fed using the balance sheet.
Nice. As always. Always take it down to the wire, don't you? Mark Cabana of Bank of America, thank you. From New York City, this was Bloomberg Surveillance.